up with A1 Trading, and now you can see all of his trades, and it's all through Discord, so I can easily check them anytime on my phone or desktop. Plus, you can get notifications when new messages are sent.
Frank, that's really cool that you can see his signals, but why are you doing that when we're space traveling?
Because I'm bored and we have light years till our next destination.
Another trade already?
Actually, have no idea what that is. We might be in trouble.
Pulver alerts are now available on the A1 Trading website, and for a limited time, you can get them 40% off for the Black Friday sale event. Don't miss out on getting Pulver alerts for the best price anywhere in the galaxy. We're dropping the link to get Pulver alerts 40% off right now in the chat and the description down below.
Nick, Frank, you watching gold?
Roger that, Pulver. We got the alert.
Every day I laugh. Hey everybody, happy Thursday. Welcome back. Fed day today, and melt up continues. Another gap higher. No problem. Grabbed some quick profit out of the SPX this morning, closing up some credit spreads. Added in, this is a bit of a long shot here, but I did take a very cheap trade. If anybody's interested, I'll show you right here. I'll put it in the Pulver alert section. It's a full risker, so it's either good or it's not. But if we have a melt up continuing today, tomorrow, if the Fed doesn't really squash any hopes and dreams, then going into tomorrow's expiration, I bought a $600 call on the SPY for 36 cents. I'll throw that in. It might be a trade that I risk all 36 cents and it's worthless. But if we have a melt up towards 600 by today or tomorrow, like post Fed and going into tomorrow, then I'm calculating a conservative move to about $1.20 credit. So there's a upwards of 200% gain on the position. So I'll throw that into the alert section. This will be under index trades. So the SPY 11/8 expiration. Buy 600 call. Right now it's trading for 38 cents debit. Willing to risk 100% of the debit. Inserting $1.20 credit for pending close order. Okay, and why would I take that trade? Looking for more melt up action here. So let me get that updated. And we'll see if that strike price gets hit. So there's my image. Now I can send it. All right, that alert's officially sent out. We'll see what happens. I did add some additional trades yesterday. So we had our pullback on gold. I put this in the Pulver alerts yesterday. I took a credit spread on GLD. I actually tried to get into Bitcoin futures yesterday, and unfortunately, I'll show you right here. So Bitcoin has had a bit of a pause at these highs. Oops. So we're sitting right here at 75K. I like the momentum to the upside. If I go to my Bitcoin futures, I can only go out to January. And the spreads, the strikes are 1,000 points wide, which I don't love. So if I were to buy the 77,000 and sell against it, I'm risking $2,000 is $2,100 to make $2,875. Now that's not bad, but it requires $4,600 in buying power. I mean, obviously going out to January 31st, we'd like to think like, okay, Bitcoin goes higher. Well, if it does, great. If it doesn't, that's a 1% risk. So what I looked at instead of Bitcoin futures was trying to go micro Bitcoin, MB for micro Bitcoin futures. And now the strikes are 5,000 wide. I can only go out to the 27th. And if I buy this and sell this, Now I'm risking 197.50 to make 302, which I do like that, but it says, I think it's going to say the same thing as yesterday. Only closing orders. Now, I think this is more of a broker thing, but it just shows there's not a lot of liquidity in my micro Bitcoin futures. So that's way more cost effective, where I could take, 2 contracts here, risk 591 to make 909. Like, I like that trade. If I want to go one strike higher, buy the 800, sell the 8,500, risk 153 to make 347. I love that trade, but I can only take it as a closing order. So this might actually require, if I can, I might end up calling the trade desk and asking them, could I place this trade? Because this one for me, for, let's say 3 contracts, risk 459 to make $1,000, I would gladly take that trade, and I could take it for partial profit. Anyway, so I'm probably going to call the trade desk after we're done with the session today and see if I can get that trade to push through on micro Bitcoin futures. If not, no big deal. But I do like that trade. Are we pretty chill for the morning? Seems like we are. I might try to throw on another trade here on SPX and have a quick peek at this. So today, SPX, kind of a repeat of what I did earlier. Let's see, 15, 17, 20, and 10. Get about $2 on the trade. Let's see, is price just going to be quiet for the FOREX and having a bit of a melt up today? I'll hold off on that. Let's talk some charts. Okay, so gold, I put in a trade yesterday on gold. So I'm looking at it this way. Okay, I like gold long term. I like gold medium term. The only thing I don't love is, what about short term? If I'm trading options, time is definitely a factor. So what I'm doing in gold is, with this dip, I thought, well, I want to participate, right? I want to participate. So what I'm doing is I'm going out much farther on GLD, and I'm putting in a credit spread. So if gold is higher, that credit spread will be profitable. Now, because of all the time that I put in the trade, I went all the way out to January 2026, which is a long ways away, right? January 2026 is a year plus. Okay. Now, the reason I'm doing that is because I think gold will be higher later next year. And my trade that I got in for like 45 or 46 cents per contract will be profitable. So I think the way I took the trade, I can check it's in the commodity section for my Pulver alerts. I got filled. It was a 245 by 240. I got filled for $2.10. So my 210, even if it decays down to $1.05 or $1 or less, that's 50+% of the profit. I can take that at any point. And if there's any additional pullbacks here, anything lower towards my 100 moving average, anything lower towards my 200 moving average, I'm good. And honestly, what we have seen for a while is gold goes up and goes sideways. So if I get in a position here and it goes up and then comes back down, I can do the same thing. I can do the same thing. And eventually I look at this area as a potential breakout, and I've got stack orders on gold to trade this out towards probably January 2026. Obviously, I'd like to keep the strike prices slightly different, so they're not all the same expirations and strike prices. That just means this is a big contract. But I mean, depending on what price ends up doing, right? So if we're going sideways and we're about to embark on another sideways range, that's fine. Obviously, everyone wants gold to go to the moon, which is exciting. But if it doesn't, just be expecting some type of range, and I'll try to exploit that in some capacity on some option trades. Okay. All right. As of tomorrow, NVIDIA is part of the Dow Jones. Would this be initial reaction? No, I think the Dow is just trying to get all sexy all of a sudden. I mean, this thing has made a huge rip from 132 to 148. There's probably going to be some additional inflows. I mean, I would just pick your battles like anything else on NVIDIA. I mean, being long is not a bad thing. I'm looking at NVIDIA this way. I still want to look for some type of gap fill. And I may not get it. I mean, heck, this thing might keep running higher, but as it stands right now, having previous resistance, a little bit of a pause here, I don't know. I'd love to see just a bit of a gap fill, come back to the 21 or the 50, then get long again. So all I'm doing on NVIDIA is hanging out with my ratio spreads. And that's it. I mean, even though bull call spreads are pretty cheap and there's a lot of momentum here, but I'd like to see a gap fill before I start getting long. And I mean, even getting, I don't know, even going out like 3 months or 6 months on Nvidia, probably not a bad thing. Okay. So I'm not selling Nvidia. I just want to see if there's a gap fill or a pullback. But if you're, I mean, look, we're long, we're at all-time highs. The thing in the stock market that keeps happening is all-time highs are good, right? It's hard to justify. Like you think about, trading forex, trading futures, trading crypto, even, you know, buying highs doesn't feel good, and a lot of times you're not rewarded for that. But in stocks, buying highs is typically rewarded because that means that momentum is there. And so higher highs and higher highs and higher highs and even all-time highs, that usually shows there's something true to that trend, and that momentum can be quite strong. So I just don't love just jumping in and throwing money at the highs. So what I do is I trade a lot of options, waiting for dips and pullbacks. I could do this though. This is probably a pretty comfortable trade. Let me see what the IV is on Nvidia. So Nvidia, let me see if I'm barking up the wrong tree here with some of the fundamentals. But Nvidia, if we're looking at this is the only thing that makes me a little bit hesitant on, buying more Nvidia at these prices. Current price 145, discounted cash flow model says fair value is 92. So I put a lot of my positions in during July and August when we had those sell-offs to try to own shares around fair value. Now, what I could do instead is the premiums are pretty decent on Nvidia. If I go out, let's say 30 days and I sell a call, I mean, for a stock that's only $148 and you're getting almost $10 for an at the money call, you can lower the crap out of these costs. So I am willing to say, could I do a ratio spread here at 130 or 125? And I think the answer is probably. And if I own the shares, I'll gladly own the shares. I've got plenty of buying power here. So just in the last, I mean, from additional profits and closed out positions, I went from about 950,000, actually more than that. I was like 850 in buying power. Now I'm up almost to 1.1 million. So I've got plenty of cash to deploy here. So I'm going to take a look at Nvidia and see if I can get something out towards, let's do a ratio spread. December 20th looks pretty decent. Currently, we're trading at 148. Level that I wouldn't mind looking at owning would be something maybe around 130 or 125. So if I were to buy the 135 and sell the 130, if I do a 130 with two contracts, I get $1.69 credit. So this is a bit of an income play. I would actually own the shares if I buy the 135. This actually might be better. I'm going to do this trade instead. I'm going to buy the 132 put, and I'm going to sell the 130. If I take the shares, which means if I get assigned below 130, 130 minus 262 minus $2, I would own the shares at 125.38. So right now we're trading at 148. I could own the shares at 125. That would give me a 15% discount. Now, this discount obviously is a big difference between, oh my gosh, Nvidia is down, 35%, and I own the thing at a 15% discount. But if I get any shares that are assigned, I can absolutely kind of wheel strategy my way out of this trade. So I'm going to take this trade. I like the income opportunity here. 260. Let's see if I get 260 on this one. So let's go into pending order at 260 is not filling. I'll at least try to get 255. 259 not filling. 258 should fill. 258 just got filled. All right, so I'm going out across the board. I might just make the credit price something that's easy to fill. 257 getting filled. Okay, good. So 257 looks like the fill price I can get on almost every account. Yep. Okay. 151. There we go. Okay, 257 is filling. And this one's still working at 257. Come on. I'm showing a mid price at 260 for crying out loud. 257. All right, so that trades in. All right, so here's the deal. NVIDIA, it's a December 20th expiration. I'm going to add this into Pulver alerts. So this is a buy the 132 put, sell the 130 put. That's 2 contracts. This is 1 contract. And 2.57 credit. So the way this trade works is if price just goes higher, I don't take any assignment and I just collect the full credit on this trade for $2.57 a contract. So because one of these cancels out, so one cancels one, leaves me with one. It's essentially like a naked put, or in my case, because I want to own the shares, a cash secured put. So I would take the shares and get assigned at 130. If price were to drop, I can get assigned at 130. Okay. But because of my credit and the long put, that's $2 off plus the 257. I own them $4.57 cheaper, which gives me a break even of 125.43. So from there, as soon as I get filled and assigned, I would immediately probably go into like a 130 call, get myself $4 and change of upside plus collect a premium on that, which might be $4 or $5 extra dollars. I can turn this for maybe a $9 or $10 share profit. And I'll happily do that on one of the probably sexiest stocks in the world right now, and has been all year. So I like the trade. So there you go. I'm gonna put this in. So NVIDIA 12/20 expiration. Let me make sure that is the correct expiration. That is correct. Doing a buy 132 put and sell the 130 put. $2.57 credit. And this is a ratio spread. I'm willing to own the shares if price falls through 130 and I'm assigned. My ownership break even is 125.43. Okay, so getting that entered in. Let me find a screenshot. Almost there. So 130. So anything upside is great. Downside to 125. There's my trade screenshot getting posted. Okay. And sent. All right, so Pulver alerts, you got it. Cool. So that's a little NVIDIA action. I mean, look, we're sitting at these all-time highs at a lot of these stocks. We talked about this last week in pre-election. If you go to the S&P close, which Wednesday was a green candle, it was a huge one plus the gap higher, and we're going higher today. Look, 600 seems within reach. And I'm not saying 600 has to get there this week, but that's why I bought that really inexpensive call in case the Fed says, yep, we're going to cut. Things look good. Inflation's going down. Whatever the Fed wants to say. If the market likes it, the market just might keep ripping up here. I do wonder, let me see if we go to, let me bring up one of my workspaces here. I'm just going to take a look at some overbought conditions and divergence. Now, we might not be there yet, but if I go to a daily time frame, okay, this is the SPY, and I have momentum, relative strength, and right here, you know, high in price, a little bit of disagreement, momentum, but we're not quite getting the overbought on the relative strength. So there may still be some more upside here. I'd be more looking at if the relative strength is hitting and we're making some lower highs there, then I'd be more likely to be protecting profits / not adding as much to these all-time highs. Okay. So point is, I like, I don't know. I think we still have some upside potential. The relative strength isn't hit on the daily time frame yet. I know on the weekly time frame it's a little closer. Like this candle's a pretty ballistic candle. On the weekly chart, I do see a bit more disagreement, but the timing of that could take, we could see weeks and weeks and weeks of trading before this actually takes hold, right? I mean, case in point would be right here. Here's a high, and there's a high. Here's a high, and we're way higher than that. So prices can still do their thing, and even if we are going, up to overbought conditions again on the relative strength, and then we go make a higher high in price, but a lower high here, I mean, we still have another 1 or 2 highs that could be created before I'd say, oh my gosh, we might have a top forming. So I'm not there yet. Plus a weekly time frame takes a lot longer. Okay, back to the daily chart. So are we overbought in the daily? No. Let me see if I can set a chart alarm at 70. Can I set a chart alarm here? Add an alert on RSI. I'm going to change this to 70. So if we get to 70 on the RSI for the SPY, I want to know. So I set a chart alarm here at that top threshold. Let's go to the Qs. Okay, same thing on the Qs. I'm showing some price and momentum disagreeing, but the relative strength is not disagreeing as of yet. So I think there's more to squeeze. There's room to run. We could pull back and we could do some intermediate gap fills. We can pull back to recent all-time high resistance. Okay, we can pull back and fill some gaps. I mean, this is like the blow off top, in my opinion. I mean, we're getting there. If this keeps stretching and all this is green, 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 then that is a blow off top. Now that's not a bad thing when you're enjoying the melt up, but at some point that blow off top is going to ultimately come back and find some efficiency. And to what degree, I don't know. Maybe it's a nasty, 3 to 5% pullback. Maybe it's a top that once it starts forming, like things get messy and nasty, but that's not here yet. So let's keep an eye on this one. This melt up is still looking pretty promising. And if it continues to go very high and very inefficiently, I would say that would put the SPY well above 600. If we're trading at like 610, 615, 620, and we've had nothing but a big gap through the election and it's been all green, like I said, enjoy that. But man, we would probably have a very aggressive like snap in January, February, just to find some type of reality. Okay. So we'll see how it plays out. But again, melt up, blowout tops, again, set the same thing here. Do we get to 70 on the daily chart for the QQQ? We'll find out. Okay, the Dow, same thing, big gap higher, all-time highs, a little bit of disagreement momentum, but relative strength has a little bit higher to go before we're technically overbought. Russell, I am pretty much out of all things Russell, with the exception of a $200 ownership price and a $225 covered call that I could roll, but I think I'm already out to December. Let me take a look at these really quickly. I have some shares of the Russell. So IWM, I have the shares. They're covered out at 225. I'm just going to let those marinate. So my max profit here is about $225. And, I want to close this out for 225 because of the covered call. It's, 216 right now. I need more time to get that thing to decay. So I'm good with just letting it get called away at 225. If it doesn't, then I'll own the small cap index and I'll just keep rolling it or adding covered calls and working my cost basis even lower than $200. But that's all my exposure on the Russell. I got out of a lot of trades yesterday. A lot of trades. I think I had like 160 some trades that I closed out for profit. And a lot of that was Russell. A lot of it was SPY. A lot of it was QQQ. So, Russell is good. I mean, I saw the trade up towards the all-time highs. I thought if there's a catch-up trade, this is probably one of the better looking ones. And in very classic Russell fashion, this thing goes so fast. I mean, the same thing is true what we saw back in late 2023. That was one of the most aggressive rips I've seen in an index. It outperformed the NASDAQ and the SPY and the Dow by a landslide. And it still is using that momentum, but we're not that far away from all-time highs. Now, I'm not calling the top here, but if the Fed is not going to continue to cut rates like crazy, then there may be some trouble ahead where this thing hits major resistance, all-time highs, and that becomes a bit of the top. That makes sense? So if we hit these all-time highs and we have this huge gap, if this thing starts to stall, I could see some gap fills on the Russell to the downside, especially if the Fed disappoints in some way. Okay, volatility index just got absolutely smashed back to the downside. That's it for now. I would say I'm going to get long volatility if we come all the way back down into the low teens. So if we get to like 13, 14, I'm probably looking at something long volatility. Time-wise, maybe out like January, February, see if there's something that kind of balances the market first part of next year. But I don't think there's going to be a lot of disruption in the markets through the rest of the year. Even like inflation data, unless like CPI news comes out next week and it prints like 2.8 or 2.9 and it's a huge jump to the upside, I don't think that's enough to really derail the market in this melt up that we see. Okay, SVXY is up. That's good. DXY, pretty much a rebalancing on the DXY. So it was a big inefficient candle to the upside. It's not surprising that we're going back down. Take this to a smaller time frame. Okay, one thing you could look at on the dollar would be this. We still have a gap to fill. If this dollar comes back to fill this gap or we take out these lows, this could be a topping pattern on the dollar. So I look to sell maybe a swing trade on the dollar, right tip area, right shoulder area, and see if this dollar gets weaker. Now, again, that would be defined risk in case I'm wrong, in case the dollar isn't topping out. But if it is, I would want to see it break the lows, right? I don't want to see this level offer support. I want to see the dollar come back in here and take out the lows. Okay, if it takes out the lows, then I look to sell a lower high and see if the dollar is going to go lower. Again, that's going to be a little bit based on the Fed as well. How dovish is the Fed going to be? Well, they're likely cutting today. 99% probability they cut today by 25 basis points. The December cut looks like 70% probability, so that's pretty good that we have 2 more cuts before the end of the year. Now, January onwards, nobody knows. The markets changed a lot. They expected like another 100 basis points cut through 2025. It's been reduced to about 40 basis points. So the Fed is likely only going to cut maybe twice next year. That's a big change. Okay, oil. I do want to take a look at oil right now. Let me go to a daily chart, CL. Now, this is a bit of a gutsy play here, but let me see something on oil futures. How much do I like this trade? How far do I want to go out on this trade? If I go to next week, I don't think I can really get these to the prices that I want. But if I did, let's say 10 delta and a 10 delta. So I can make a couple $100 on it. This is what I don't love. The buying power is insane. I mean, to tie up $11,000 just to make $500, no thanks. So if I create a defined risk trade, 66.50, define the risk a little bit, 79 to 80. Now I max out at 120, which I'm going to take partial profit anyway, so that's not a good trade. Plus, it still ties up. It's about a 10%. Yeah, it's just, I don't know. I don't love it. So never mind. I told traders this morning I was going to take a look at oil. Basically, what I'm looking at is this. It's a futures trade. If oil is just going to continue to be choppy, well, there's a good opportunity to take advantage of it. I mean, going out, I probably need to go out like 45 days. But if we went out 45 days and we stayed choppy, I mean, maybe that's priced a little bit better. But let me go out a little bit further. If I go out 39 days on CL, that gets us out to December 16th. Let's see. Go up a little bit higher, maybe a 15 delta. and a 15 delta. So if I define the risk, so now I can make 200 bucks. It only takes about $614. Now that's not bad. But the problem is I wouldn't be going after full profit. I'd be going after like maybe a 50% take profit here, which makes me 105 bucks. I'm still risking $800 if oil has a big nasty move, but it is risk defined, so it's not the end of the world. Could I go a little bit wider? Maybe $2 wide and $2 wide. So I make 380, cut that in half, go after about 190 bucks. Let me see what that return on risk is, or return on capital. So 190, if I hit the 50% take profit, divided by 1187. But a 16% return on capital. What's that return on risk? 190 out of 1620. But a 11.7% return on risk. I don't know. I mean, probability wise, it's probably fine. This trade shouldn't take 45 days or 39 days. It should probably take, I don't know. IV is 61. If I could keep the loss a little bit tighter, I guess if I tighten it up. How about this? I'll just do an iron condor. See what this looks like. So now I make 100 to risk 400, and by December 16th, if oil is below 84, if we're below 84 and above 62, then I'll just keep the full profit. If I move these up in strikes, try to see if I can get a little bit more premium here. So instead of that's a 15 delta, let me go 16 delta. So I make 120 bucks, risk 380. It's not awful. 16 delta. All right. I'm just not excited about a partial profit. If I make 120 bucks, that's okay. If I take a partial profit, I mean, 50, 60 bucks is not that exciting for an iron condor on oil. So obviously I'm hesitating to take the trade. I might as well just not take it. But look at the difference in the put side too. I mean, a 16 delta put is way closer to the expected move than what I'm seeing on the upside right now. Like the 15, 16 delta upside is way up here. So, I mean, credit-wise, 76 cents, 85 cents. I'm actually getting a bit more credit on the call side, which is interesting. So there's a little bit of pricing skew on oil right now. I'm just not that stoked about 120 bucks. So I'll pass on oil. But the idea of the trade would be this. 62 is down here. Okay, 80 and change is up here, and price is right in the middle. So all you need this instrument to do is just stay here. If it stays here, then if I collected 0.12 credit, which is $120 max profit, if this all of a sudden starts trading for 0.06, well, there's your 50% profit, right? This starts trading at 0.01. Well, you just made $110 on the trade. And that's roughly how I take it. But to wait for that trade, you got to be out 39 days. If anything silly happens in the Middle East and we all of a sudden break the lows, then you're on the hook for that full risk, which is about 380 bucks. But to take that trade, I would definitely define the risk and not run any type of assignment risk. Okay, so anyway, it's a lot of conversation for not a lot of trading on that one, but I thought I'd at least look at it and talk through it. Gold, I still like gold. GC, it's expensive to do a ratio spread, so I opted to do GD instead because I want to buy some more shares and hold more shares of GD or GLD as well as SLV. Because if I looked at GC and put on a credit spread, I don't think I can go out as far as I want to on GC. Let me check. So GC, right now I could go out to, I can only go to February of 2025. If I want to go out way longer than that, I would, but this is an expensive trade. So if I were to trade, let's say a bull put spread, or I guess I could do a bull call spread. So if I were to buy the 2750, so I can risk 220 to make 280, that's not a bad trade. The only issue is I've got to be right by February, which means Gold pullback is essentially done, right? And that's what I'm declaring. Like by February, if I take that trade right now, I'm saying that I buy a call, sell a call, and I need price to be higher by expiration in February. Now, like I said, if we go into this level and we pull back deeper and deeper, this bull call spread is probably a loss. If I could go out further, I would have a lot more confidence giving myself, 6 months or 12 months to say I think GC is going to be much higher. Okay. So if I could go out further in gold futures, I would, but that's why I'm taking GLD instead. So that's the trade I posted yesterday in Pulver Alerts, and then SLV, same thing. I don't mind owning shares of either one of them. And that means if the pullbacks get deeper, I would be willing to own some more shares. GLD, same thing. If the pullback is deeper, I could actually close out the long put, take on some shares, and then just repair it. Otherwise, I'm just going to keep adding more credit spreads. Okay, SI, let me see how far out I can go on SI. It's probably similar. I would imagine the futures contracts are only going out towards March of 2025. So this one's not bad. A bull call spread, let me see if I buy the 3250. So I can risk 530 to make 720. If I move it one strike up, I can risk 495 to make 775. I mean, I don't mind that trade. But again, I only have until March to get it right. So I like it, but timing-wise, if silver has any additional pullback, which maybe it does, maybe it doesn't. But if we don't have much of a pullback, that's an easy win. If we do have a pullback, then it's defined risk. I think if I just go out farther, I can make more money. It's that simple. And going out to March is kind of far, but I'd rather go out to like December of next year and say, I think by December next year, this is, high probability we're going to be higher, which gives me a winning trade. But I don't mind the trade. I mean, make 755 on 495 risk, or make 4 or 810 out of whatever this is fluctuating by, a couple cents. So I just wish I could go out farther. And maybe as we get into the end of the year, maybe those future contracts start to sprinkle in more for 2025, and I can revisit that trade. So I'm just going to be patient. That's all. Okay, Bitcoin, same thing. I talked about Bitcoin futures. IBIT is looking much better, which is exciting. BITO is looking better. I did put in a $14 call. Let me see what this is trading for right now. I went out way out in time. Let's see here. I'm curious. I paid $5 for it, but IBIT. Where are you? There. So I have some shares. It's up some profit. Have some shares, up some profit. Where the heck did my call option go? I'm looking for that $5. So I've got some dollar cost averaging levels in. Oh, never mind. It's BITO, dummy. I'm like, got to trade the one with options. All right, BITO. This should be easier. All right. BITO. There it is. There's my $14 call. Right now, that $14 call is up around $284. So that means it is trading for, let's see here, 6 and change. That bid and ask is quite wide though, so I don't even know if I can get filled at the price I want. So it shows that I'm up $284 on that trade. It is unlimited upside. I mean, I guess the Bitcoin's, I might as well feel this out. If Bitcoin spot price goes to 100K, this instrument should be higher. Now, I don't know if we're getting all the way back up to 34 and change. That was kind of the wishful thinking on the trade. But if I can take a $5 debit and turn it into a $10 credit, that's pretty good. $10, $12, $15 credit, that's even better. I calculated out here to be, closing out around like $20. Okay, so anyway, we'll see. I mean, this is probably one of the more exciting setups for the remainder of the year. I know Nick and I will talk about a lot of things next week. If you're interested in joining us for a November 12th, 10 a.m. session, I looked at the presentation deck yesterday that the team put together. It looks great. So we're going to have a lot of fun next week. And one of my favorite trades right now is just really being long Bitcoin. I'm trying to find more ways to do it. But I I can't, like, other than, I guess right now, I mean, hell, I might as well add a little bit more to it. IBIT and FBTC. So it's a little bit cheaper in IBIT. If we're going to 100 grand, this one's getting up towards 57. Okay, so I'm going to buy some more shares of IBIT. And I hate buying it at the highs, but I do think that this is momentum, and this is a momentum instrument. So I'm going to buy some more IBIT. And right now, and also if I have enough shares of IBIT and we get cleared for options with the OCC and CFTC, then the shares that I do have, I can also start adding some options around it, which will just kind of give me a head start. So I already have some exposure on IBIT, which is right here. So I've got 200, 200, 100, 300, 300, 371. I'm going to buy 29 more shares on this account to make it an even 100. So let me go long the stock. So IBIT and long the stock. This would be another 29 shares at 43.29, 43.28, hopefully. $29 shares, yes. Okay, 29 filled. Okay, so that got filled, which brings this one up officially to 100 shares. So now I have 100 shares of IBIT. I'm going to throw in another 100 shares. So if we get 100 shares and it rips up here, that's another $14. That's $1,400 on that tranche. I can peel those off, add some options. I'm hoping by January 2025, we actually have options cleared for IBIT and FBTC and a couple other those spot ETFs. But these look pretty promising. Now I know there's potentially a gap fill here, but I like the potential momentum. So I'm going to buy some more shares right now. So long the stock. That is in, long the stock. Let's see here, buying power. So I'll go 100, 100, 100, 100, 100. Let's see, this one. Buying power. I'm just going to be a little bit more sensitive on the buying power. That's a little bit less on the option side. These are some of my IRA accounts, but all right, this one, no worries. So another 100 shares. At 34, 35, filled. Come on. Don't make me chase it up too high. Okay. And 9151. And 9072. Okay, so added in some more shares there. So and again, if you're interested in this one, I just added some shares. I could put this into the, I guess I'll put this under stocks and options, even though this is more Bitcoin. But I'll throw it in there. So stocks, options, this is IBIT, buying shares, adding another level of ownership at 43.35. If Bitcoin hits 100K, IBIT should be trading around $55. I've got it measured out right here. So around 50, actually 57, that's even better. 57 to $58. So I bought some more. Buy at 43.35. Targeting the 100K Bitcoin level. So there it is. All right, throwing that in Pulver alerts right now. That'll be in the stock options trade section. And sent. Okay, I got to add that into my spreadsheet as well. Any charts you want to take a look at today? Any currencies? Anything? I know I've just been going through a bunch of random stuff and throwing on some trades, but new trade in NVIDIA, I've got to add that in. All right, so I need to put in NVIDIA, IBIT. Any other trades that I took for today's session? That's it. Okay, so IBIT, NVIDIA, new trades on the day. Ethereum, oil. Yeah, I talked about oil for a second. So oil, I think oil is just range bound. Oil still looks range bound to me. So what I was looking at on oil was trading CL for oil futures and just doing an iron condor where I can have a bull put spread down below, bear call spread up above, and just looking to see if you can extract some time decay and take some premium out of that. I just think oil is going to be choppy, and it's risk defined. So if oil crashes or oil rips, it's defined risk. But I set up a trade where it was about $380 of risk. Ugh. Apparently my mouse is flipping out of me. So about $380 of risk for about $120 of profit. So it's not great. And usually on iron condors, I'm not trying to hold all the way to expiration. So on that trade itself, it's like, I just don't like taking this trade for a couple $1,000 buying power and only making like 50, 60 bucks of profit. So I'm not going to take the trade, but I think oil's still range bound. That's really what I'm looking at. Okay. All right, real quick on the Japanese yen. Yeah, the Nikkei 225. Sure, we'll take a quick look at that one. So Japanese yen continues to do its wild and crazy thing. The Nikkei is, I mean, honestly, if I could put a strangle of some sort, an iron condor on the Nikkei, I think that'd be another good trade. But this has been pretty much a non-mover since the July to August drop. Like that was the big deleveraging in the Japanese yen. Currencies did all sorts of wild and crazy stuff over that month. And then from that point forward, we pretty much just recovered to the 50% point and we haven't done squat. So look, I still don't mind going long Japanese yen, or I'm sorry, going long the Nikkei if we get some pullbacks. I'm just holding off on this right now. It's just a non-mover. So I mean, if you can trade the index and actually trade some options on it, that's what I'd like to do. But I just think we're in no man's land right now. Gold, we did a bunch of gold already. I put some trades on a gold. Aussie yen. I mean, yen pairs are garbage, man. I mean, all the yens are doing right now is just showing more positive swap. That's all it is. It's right back in the same game, a slightly positive swap. It's not probably as aggressive as it was before when we had a 2-year carry trade. That's what this was. This was that very aggressive unwinding of the carry trade. But I've said this for months. This high and this low means something. And I think that if you're a Japanese yen trader, you're going to have to figure out how to survive up, down, or sideways in this area because we're not going to break this high and we're not going to break this low. And I don't really want to trade that. So I'm not trying to trade Japanese yen pairs when I think it's just going to be back and forth and choppy and volatile. When I look at the currency strength chart, one day the Japanese yen is strong and one day it's short or weak. I just don't think there's any consistency to it. So I don't like it. I would say if I'm looking at the Japanese yen, if we come up high enough and we start to turn south, I like that sell trade. If we come down low enough and we find support, I like that buy trade. But, defined risk as well as good reward to risk setups. Otherwise, I'm staying out of the yen. I have no interest in the Japanese yen. If the Nikkei is not moving, Japanese yen's probably not moving. If the Japanese yen futures market isn't doing much, Japanese yen itself probably isn't doing much. So I think you're going to just deal with a lot of back and forth chop. The bias would be right now to be slightly favored towards long against the yen, positive swap. BOJ is probably not raising rates again for a while. And as long as we have a risk on type mood in the market, then the Japanese yen will likely stay a little bit softer. Okay. BXY, I don't know. I know what it is. British Pound Currency Index. Well, I can trade. There's a futures market on this one. So this is pretty much the same look as the pound dollar. So if you're trading BXY, you're trading the pound dollar. That's what the exchange is. So here's your pound dollar, and I'm long on the pound dollar right now. So I'm using my daily time frame. We pulled back to that 200 EMA. I took a buy trade in. I'm dollar cost averaging for 2 spots. Stop loss below the trend line. I'm looking to see if the pound dollar, which would be the same thing as going long BXY, is going up. Okay. So this morning we did have a rate decision by the Bank of England, and we have a rate decision today by the Fed. But as far as the currency strength goes for the morning, we've got dollar weak, Aussie New Zealand on top. This is also a bit of that comeback trade on China, which hopefully that happens. Pound, did they actually cut rates this morning? I'm assuming they did. It was already priced in. Yep, they cut rates by 25 basis points. Monetary Policy Committee voted as expected. So, all right, it's all about the Fed. So anyway, I'm long pound dollar, which is you're asking BXY, it'd be long BXY as well. Okay. All right. On that note, I think I'm coming back at 1:30 for a little FOMC session. Maybe tackle that with Nick. And then I would encourage you, if you haven't signed up for the November 12th webinar, which is next, sign up for that webinar. We're running through the rest of our trades and projections for 2024, also big trades and strategies in 2025. So sign up for that webinar. Pulver alerts are going live. We got Black Friday stuff happening right now with Edge Finder, Stockbox, all the goodies and giveaways with Edge Finder. So get your hands on that great software, and if it helps you to have some alerts, cool. With my alert section, I'm throwing in a free strategy course called Practical Options. So anybody that has my alerts to go with the any of the Black Friday sales, I'll throw in a full course. It's in my trade alert section. You can check out the whole video. So it's like 4 hours long. You can obviously splice it up. It's like I guess it's 11 sections, but it's all one giant video. Okay. All right. And I'll see you in a little bit back at 1:30 or so for FOMC, and see you then. All right. Thanks, everybody. Bye.
This was our best year yet at A1 Trading. In 2024, we brought the incredible Chris Pulver in and gave you guys access to all of his trades and analysis through Pulver Alerts. We also introduced our newest market scanner, the Stockbox, whose AI algorithm is scanning each and every day to provide you with bullish or bearish biases on the top stocks and stock sectors from around the world. Not only that, but the Stockbox gives you a behind-the-scene look at what the largest hedge funds in the world are buying and selling through the 13F scanner, so you can keep up with what people like Warren Buffett or Steve Cohen are adding to their portfolio. The best part of all, both of these products are on sale now for a massive 40% off during our Black Friday sale event. The Stockbox, the Edge Finder, Pulver Alerts, and the VIP Discord community, as well as our Trading View indicators, are all on sale for 40% off. This is the absolute best discount of the year, hands down. So if you want to take your trading to the next level, don't miss out on the 40% off Black Friday sale event. You can find out more with the link being dropped in the chat now. Again, 40% won't last forever, so take advantage of this huge sale. Stockbox, Edge Finder, Pulver Alerts, VIP Discord community, and Trading View indicators, 40% off right now.
All right, guys, welcome back. I'm bridging the gap here. We've got our next guest coming on in just a few minutes. Shout out to Chris. That was awesome. Having him on every day has been a major improvement to the A1 Trading Show. So I wanted to just within my few minutes here before I pass the show to our next guest, actually take a look at some stocks here just a little bit today. And also shout out if you guys would like more Chris Pulver. He's got his own YouTube channel. You can also find him in our Discord channel. He was mentioning that just before he went. He dropped, guys, the man dropped a 4.5 hour course for Pulver Alerts users. If you're somebody who is already signed up to the Pulver Alerts service within our Discord, go check that out. I mean, he just dropped an extra, 4.5 hour long detailed course on his trading strategy, which I thought was an awesome inclusion to the Pulver Alerts. So yeah, that is 40% off, by the way, as he was mentioning. Okay, let's talk some stocks here for a second, guys. In fact, we have like some tool thing here called the stock box that we could look at to help us with this. I love this heat map thing we've been working on, by the way. Check this out. Got some of our biggest gainers and losers on the day. Tesla's doing its thing. Airbnb is up. I own Airbnb, by the way, which is awesome. Tesla, I own. Although I might get called away from my shares. I sold some covered calls on Tesla. Airbnb, I just own shares. But SMCI, can we even just look at this stock for a second? Super Micro Computer is having a super awful year. It was having an amazing 2023. Well, I guess, if you had held from the start of this year until now, you're only down 15%, which I guess if you'd bought the top, you're down 81%. This is the thing about individual stocks. There's a very good case to be made for trading individual stocks and a great case to be made for trading indices that hold many stocks in one. Now, the reason that there's like a case to be made for individual stocks is, many investors, they just say, look, why do I need to be so active in the markets to try and just beat the S&P 500, which is doing just fine by itself? Let's not fool ourselves. If you just bought and held the S&P 500 in the last 20 years, you're very happy right now. I mean, you're up 600+% on your money. So if you put, $10,000 in there, you've got a lot more money now, right? But what is the case to be made for individual stocks? Well, basically it could either accent this and massively increase the percentage you could gain. Let's go take a look at American Express. Or to finish that thought I was just on, it could do the opposite. You could have a massive, loss if you pick a bad stock. So what's the case for stock picking? Well, look at American Express. If you had picked American Express, which was a pretty solid business in 2001, compared to the S&P 500's 600%, you could have made 1,000%. Now, I know this is shoulda, coulda, woulda stuff, but my point is basically this. What's the benefit to picking good stocks? Well, if you can do it, you can massively outperform. The difficulty is that a lot of stocks fall off. A lot of companies, yesterday's winning companies are not necessarily today's winning companies, right? That's the difficulty with stock picking. But like, look at Uber, right? If you had picked up Uber in 2022, this thing's up like 170%. In, the same time, the S&P 500 is probably not up nearly that much. Palantir, I mean, this is one that Frank owns, and I'm jealous of this. I mean, look at this thing. This thing's up 600% in a year, not 20, So this is the pro and con, right? The difficulty here with picking stocks is it's very easy to look at the ones that have already made ginormous moves and to make the mistake of thinking that that is certainly going to happen again. Like Nvidia, for example. I bought this stock. Well, actually, let me expose myself first. I bought this stock back in 2022 and sold it like way too early. And then the stock ran up and I decided I wanted to buy back into it. And it finally had a drop of, at one point, I got it, 25% off. It's shot back up since then. This is just one that I've held in the portfolio. It's not a huge position for me, but it's a stock that I just wanted to own. Tesla's another one that I've owned off and on and traded off and on for since 2020. It's probably my favorite stock to trade. Not necessarily to invest in, but I really like trading this name. It has very high volatility, and as an option seller, which is what I do a lot of with the stock market, I love this stock for that. Selling covered calls. I did sell a covered call at 290, which is whatever. I'm going to get called away from my shares at 290 for a profit. But if this thing keeps flying, then I will have missed out on some of the gains. But anyways, Tesla's a stock I like. This thing is a monster. We're looking at the weekly chart here. You can see it actually came back and retested this gap open area and has now just shot to the moon recently. So some crazy volatility on that front. Guys, we've got Kenzo, who's going to be taking over the show here. He has arrived in the backstage to share some ideas and thought process during our marathon stream here leading up to the FOMC meeting this afternoon. I'm going to hop off the camera here for a little bit and give the show over to Kenzo to take a look at some charts and ideas. So what I'll do here is just a quick reminder. Remember, our Black Friday sale is going on right now. If you guys have any interest in getting access to the Edge Finder or the brand new stock box, for example, it is currently the biggest discount all year long. We're doing 40% off. If you have any questions, you can send us a direct message on our website. There you go. The link is in the chat, and the information about the discount stuff is in the description of this live stream as well. There's a promo code there for you. Okay, we'll take a quick break, and then Kenzo is coming up next. Check it out. If you're someone watching the show right now outside of the US looking for a better brokerage, listen up. I wanted to take a moment to mention today's live stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on TradingView.com. Not to mention, they also have a really good sign-up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show.
Good evening, guys. I hope you are doing great. So what's really happening on the market? I think everyone is still waiting for that FOMC committee to see if maybe are they going to cut the rates or not. So, but since we are on the market, while we are still waiting for FOMC, you can just let me know which pairs do you want me to go through and just to update and see what we can get from those pairs. Already we saw that our stocks are already flying. I think the stock market likes the new US president. That is actually good because we also want to see the markets going even higher. But at the moment, we saw that as we are going to still go on US30 and NASDAQ, we saw that they've been like seriously flying so bad. So I think maybe along the way, we might have some sort of reversals. But since there is rate cuts later on, maybe we might start to see another push to the upside, or maybe on the conference. Remember, when there is a FOMC committee, the most important thing is the conference 30 minutes after. That conference is actually something that they're going to just tell us what do we expect or what we must expect next, because now it's already here. So the question will be, what will happen on the next FOMC committee? So if maybe the news are still looking good, if they still continue about cutting the rates, that will be good. But if they say, nope, we're cutting today, but we don't really see any rate cuts coming this year, which is going to be around December, I think that might actually have some negative effect for now, but the overall structures, I think, or the overall market is very healthy. I think the market will be going up. So now we are on a dollar index. We use dollar index just to gauge the strength of the dollar. So we saw that the market was playing, or actually the market reached our resistance area. It's been there for quite some time. You can check that on a daily time frame. So we can see that the market actually did reach this area, and it seems like the market seems to be respecting that level. So the question is, after maybe after FOMC rates cuts, will we see a continuation of this sell? I think it's possible. I think it's possible we might start to see a nice sell of this DXY. And if we see a sell here, that will be meaning the dollar is cooling off, and that will actually be way much better for the stocks. You see, so at the moment, I think the stock market reached the level of a resistance, but we have to wait for the market to show us what will happen after the news. So I will go straight to gold. I see gold, it's now reversing. If you checked gold yesterday, it was actually selling. So let me zoom it a little bit. This is a daily time frame. So you can see that the market was actually, the market is still on this nice uptrend structure. So what happened is during the votes, I think maybe it's because maybe it shows the confidence with presidency of Trump that made the dollar to be a little bit stronger. You see, yesterday. So today it seems to be reversing again. You see, but the question is, will it continue to go even higher? Because the reason behind this is when Trump he was still campaigning, he was talking about ending the war, let's not start any war. And that is good, obviously, but it's not really good for gold. It's not really good for gold because gold actually likes uncertainty. If maybe there is conflicts, if there's geopolitics, gold tends to go higher. But if there's no tensions, it means every economy or every country, they will be focusing on their economy. Every country will be focusing on their economy. So which means we will be expecting some growth on those economies. So now we tend to forget about gold. And yeah, gold will actually lose some momentum. If indeed Trump is not gonna, if maybe he is going to stop, let's say, Ukraine and Russian war, or let's say tensions, or let's say another one is going to be Israel and Lebanon or Gaza. If he can do that, I think we are going to see gold going even lower. I think this was the start because if there is no war, it means it's better to invest in the companies which are going to grow, growth stocks, you see. So, but the overall structure here, it was very aggressive. You can see that the market was going up. So after we had that reversal, I think this is the first sign that there is some weakness on gold. So there is a possibility that it can still push even higher. But at the moment, there is a room for that reversal, especially when we already broke out of this support area. So maybe the market wants to retest where the market broke out before starting to go lower, or maybe the market will recover all this or the whole candlestick before maybe we see another reversal. But going further, I don't think we're going to see any bullish move. I think slowly people, they will be offloading their gold. So I think that can be something. You see, so any pairs that you want me to check? What do you think for stock today at FOMC and gold now today? What do you think for stocks? So let's say for now, whether they're cutting the rates or not, let's say they will cut with 25 basis points or 50. I think the most important thing at the moment, it was interest rates, or let's say FOMC, which is something that we are waiting for. But we also had elections. So those elections, it's actually something that at the moment is very, very important. And Trump presidency, it seems to be favoring business or let's say stocks. So even if they don't really cut now, but going further for this 5 years or 4 years, I think the stock market will actually perform very well. So I believe that stocks will actually continue to go even higher. But gold, even if they cut, I don't think we might see a nice jump, but I think along the way we will have a proper reversal. Because actually, as we know, Trump is actually a business man. So obviously business likes him. So he tries to make business everywhere. So I think, yeah, I think US economy is gonna bounce back very aggressive. You see. So any pair that you want me to check at the moment, I will start with Nasdaq. You will be telling me which pairs to check. So on Nasdaq, I think we can easily see that no, this thing is quite flying, and I think it's good. It's actually a very good thing because one way or another, I think the market will likely reverse along the way. I don't think this is gonna just go for the whole. Maybe we might have some going higher. Even if maybe we don't really get any reversal now, but along the way, the market has to give us something. I'm still very bullish like that. I think it's better to wait for a proper reversal before we see a continuation of that buy. I don't think it will be safe for anyone to. I don't think maybe it's good for anyone to just jump in there unless if you don't really mind, because a sell-off might be there. And once the market sells off, it doesn't really mean maybe the pair is weaker. No, there is investors who are going to take their profits. And by taking their profits, it means they offloading the weight or this bullish momentum. If they offload that, we will see a smaller reversal. Then after that, we will see the market trying to push to the upside. You see. So yeah, I see Euro JPY. You can also add other pairs. Before I go on Euro JPY, let me go on US 30. So US 30 also bounced back very nice. So we can see that yes, the market is still on this nice bullish move here on a daily time frame. I think on 4 hours time frame you can't see much because yeah, the movement here is like seriously aggressive on the bullish side. So yeah, at the moment we see that the market broke even the highest level that we had of this resistance. So I'm expecting to see the market going even higher. But what I know is one way or another, there must be a nice reversal before we jump in on that buy. I don't think maybe it will be safe for anyone to jump here. Obviously, if you missed that, obviously you will think twice, but it's better to wait before we jump in. Maybe the market might even reach this level. It's possible. It's possible. So, and I think but the thing is, I think every economic news that we have at the moment, plus FOMC that we're gonna have later on, I think things are looking good. I don't see any bad effect or aggressive sell-off. Yes, a sell might be here and there, but I don't really think we might have a sell that can reach around 42,500. I don't think so. So I think maybe a smaller reversal can actually help. And it seems like US 30 is trying to do that, you see. So yeah, now let's go on Euro JPY, then we'll be going on GBP CAD. GBP CAD, Euro JPY. Guys, I sometimes take these things out because I trade very few pairs. So that's why I always search for them. So on Euro JPY, it's Euro JPY, right? Okay, yeah. So on Euro JPY, the structure, it was very straightforward. Before we had a proper uptrend, it was moving like that until the market started to do what? To break out here. Do you see that? Let me draw that with a proper line. Maybe you will see that. I think it was around this level. Let's draw that properly. Then this nice bullish move there, let's do double lines. Something like that. So that was our previous support area. And then the market decided to break. You can see here, the market decided to break here. And we can see that the market is still very closer to where the market broke out before. So which means there is a chance for the market to respect this level and go even lower. But the market is not forced to do that, because we also have another structure. If you check nicely here, you will see that we have another structure. If I start here, let me just try to draw these zeros here. They are actually making sense. If I connect this zone there, it makes sense. So we can see that the market moving like this. So which means now we have this mixture of some structures. But for us to not fail to identify what's really happening here, we have to mark this level so that if something happens, we will know that, okay, the market is taking this type of a move, because this shows us that the market respected that. You see that even though we had a breakout, obviously we can conclude and say, okay, we are on a downtrend if we can see that the market respected this level and is trying to go even higher. So what we can do here is, because sometimes it might confuse where the market broke out, we can mark that level, because sometimes, or let's say most of the time, the market tends to respect the level where it broke out. So this is what we have. It's where the market broke out before. It seems like the market is respecting this level. Do you see that? Another one, it will be like this. Let's add this area there. You can see that. So now we can say, for us to say, maybe we can conclude to say we are now on a buy. We can say if the market breaks this previous resistance, then we can look for a buy above this resistant area. But we can still look for a sell, because the market was going up and it created this support area. So if the market gets out of this support area, we can mark this. You can see it makes sense. So if the market breaks this area, this will also be a very proper sell. So which means at the moment, the market is just playing around the same level. We can just call this ranging. The market will be ranging after we had this breakout. The market is just playing around the same level. If it breaks this level, if it breaks this zone, resistance zone, then we can conclude and say we are going to look for that buy. But at the moment, we have to just wait and see. Check NVIDIA stock. Okay, I will check NVIDIA stock. I will check GBP CAD. Let's check GBP CAD before we go on NVIDIA. I don't think I have GBP CAD. Let's see. GBP CAD. What's happening on GBP CAD? Let's go. So firstly, as we are already on a daily time frame, before I even draw anything, you can see I don't really have any analysis here. It's obvious that the market is actually on a very proper uptrend. The market has been going higher. So the best thing here that we can do is to try to find our proper support area as the market is actually going higher. So you are not forced to go way too back last year or whatever. We still have structures that we can connect, because we're moving forward. We're not actually going back. Yes, you will still connect some other structures along the way, but most likely you have to move forward, especially when you have structures that you can use to connect. So at the moment, I will try to identify this, that, and try to mark these structures. If they make sense, that is a proper support or resistance. So we see a move like this. So it seems like the market just moved away from the support area. So which means we'll have to wait and see. Let's draw this. I think it's perfect. So let's do double lines, because this is a zone. It's a zone, so the market won't just respect one candlestick. So it has to play around this zone. So this is what we have. We are on this nice bullish structure. So I think already the market, you can see, moved away from our support area. So obviously the market is moving like that. I hope you see that. This is a proper or very stronger support area. So which means we are on a very stronger bullish momentum. So we are supposed to look for a buy. But I think I see something. If maybe we go on a smaller time frame, like not smaller, let's say medium-sized time frame, like 4 hours time frame. On top of there, it seems like there is a smaller resistance that we can use. You can see that we have something there. So if the market breaks that level, yeah, we can say the market shows us that it's in. As we are on this nice uptrend, we can jump in above this level. Then we can buy after the market breaks out. Or maybe the market will just consolidate around this level. Once the market thinks twice, we might see another push as the market did this around the support area. You can see every time once the market is very closer to the support, we see a very proper push to the upside. So this actually makes our job to be quite simple. I think this pair is very clean. It's very, very clean. So the time is going very quick. Let's go straight to USD JPY and see. I hope I'm not actually... I hope I'm not taking a very long here. So yeah, now we are on USD JPY. What's really happening on USD JPY? USD JPY is quite similar to, I think it's GBP JPY. I think we did that analysis. So that analysis was showing us that we had this type of a structure where the market broke out, and it seems like the market is now trying to bounce back again. Sometimes this type of structures might confuse because most likely they were controlled by fundamentals. So there were like interest rates from JPY side, they were increasing some rates, then it started to be stronger. JPY started to be stronger. Today they will be cutting the rates. I think where we are, you can see where the candlesticks is. So it was our previous support area, and perfectly we can start to see the market moving away from that. And if they cut the rates one way or another, the dollar will be losing some momentum. So which means we might start to see the market reversing again. Maybe the market will be trying to bounce back around this level again before going up. But if maybe things are not really nice, yes, rates cuts are good for the market because when they actually cut the rates, it's because there is a slow in the economy. Economic activities are very slow. So if they cut the rates, it means that they want to boost the economy. So obviously consumers, they will start to buy because the rates are lower. Mortgage will be very cheap. Buying a car, it will be very cheap. Loans will be affordable. So which means you have an extra cash that you can spend. So that will fuel the market to do what? To have enough activities. So cutting the rates, it's good. I hope you understand that. So I think on USD JPY, we're good. Obviously, the market here, I think we might see something here. But this structure actually, it is still actually showing us that it seems to be trying to push up. If we break this level, it's obvious that we will be continuing on that buy. I see Bitcoin. Someone said Bitcoin, and someone also said NVIDIA. Let's check NVIDIA first before we go on Bitcoin. So NVIDIA has been on a very nice bullish move. I like this stock. It's been going up very nice, but yeah, I think momentum is just a stock. I don't think maybe we'll have to do much here. I think we are still going to see some very nice push to the upside. Things are looking good. And other companies which are actually using AI or which are still going to have AI in future, obviously most of them, they're still going to buy those AI chips from NVIDIA. So this is actually a very good thing for NVIDIA. And we expect NVIDIA to still grow. I think it's this week, NVIDIA is going to replace Intel on US 30. Now we're no longer going to have US 30 on the list of US 30. So Intel is not longer going to be there. So this might be a very good thing for NVIDIA. So I think we will start to see it going even higher. So this is something that you should also know. I think it's going to be listed this Friday. I no longer remember. You can check that. So yeah, I still believe that we are still on a very nice bullish move there. A buy and hold, it's a very good thing. I think we're still going to see some serious AI stuff going further. So another one is Bitcoin. Let's check Bitcoin very quick. I think my time it might be up. Where Bitcoin? Okay, okay. I see the other one here that I already added. Where is Bitcoin? So Bitcoin seems to be moving very nice. Okay, Bitcoin is enjoying this. So we know Trump actually he was pushing also crypto. Let's hope that is going to be positive about it. So I think we're going to see some very nice push to the upside. So at the moment, yes, I think everything still looks good. We had a proper structure going down. The market was actually slowly going down, but not really aggressive. We see the market was pushing lower. Few, I think yesterday, I think the market started to break here, or Bitcoin started to break that resistance. This shows us that we are now on a very nice new records. So obviously, I'm expecting to see more. I think this move is nice. I was expecting to see some aggressive. So maybe along the way, once they cut the rates, I think we will see Bitcoin fly for quite some time now. But at the moment, I think the structure is very clean. It's straightforward. Yeah, I think everything is straightforward. So any pair that you want me to check? Bitcoin get related books will push. Okay. 20 November comes report. Okay. Any pair that you want me to check? I'm trying to check if maybe I missed something that you wanted me to check. I think I did not really miss anything. So let's go and see if maybe we can get something on gold. Let's see. Let's see if maybe we can. Oh, let me check. I did. If you did bought this, it's a very good stock at the moment. So we expect it to go even higher. It was a little bit lower, but yesterday it was like 12% move. That means maybe before the close, it will be around 4-5%. So yeah, it's moving very nice. It's moving very nice, and I think it's easier stocks to trade. It's easier to make money on the stocks at the moment. So I don't know any pair that you want me to check. I will be trying to check gold. What's really happening on gold? It seems like gold is still trying to go even higher. So it seems like we are going to just have to wait and see. But I'm just waiting to see if maybe it will break this area where it was our previous support. If it does that, it means we will see another push. But as I said, I don't think we are going to see a continuation of this, especially when Trump is a president. So I believe that maybe he will try to cool off some of the tensions all over the world, and that will be good for economies, but not for gold. For gold, that will be slowly going even lower. You see. Yeah, I did check Bitcoin, but I can just check that now for you very quick. I don't know if my time is up or not. Let's check Bitcoin, Euro JPY, and other pairs that you want me to check. So on Bitcoin, I think it was straightforward. Let me just go on a daily time frame so that you can see, because the structure it's massive. So this is what we have. You can see that. This is what we have. So the market actually broke out of this resistance area. So I believe that, yeah, the market might continue to go even higher. Along the way, yes, the market will reverse, obviously, because some people are taking their profits. So it's obvious to see some swings around the level. But at the end of the day, I believe that we are going to see a proper push to the upside. Sorry, I think we're going to see a proper push to the upside. Let's see. Euro JPY. I think I did check Euro JPY. Any pairs, guys, that I did not really check? I think I did check Euro JPY. Euro JPY. Let's see. Yeah, I did check Euro JPY, where it was actually on this resistant area. Seems to be trying to reverse. Seems to be respecting this level where it actually broke out. It seems like the market will end up trying to go even lower. I think that it's actually good. I think the market will be trying to go even lower. US 100 US oil. Oh, I did not really see this, guys. Sorry. German 30, Nasdaq 100, and US oil. Let me check German 40 and US oil because I did not really check them. So let's see. German. Where's US oil? Let me check US oil. So firstly, US oil, it was actually struggling, going up. It was struggling. Let's see. So this is what we have on a daily time frame. On the bottom here, we can see the market. Or let me just draw something like this. This is what we have on US oil. So on US oil here, let me just go closer. I think 4 hours time frame might also be much better because daily time frames can be way much bigger. So let's see. So yeah, I think it's also good here. So I'm expecting, I think for 1 hour, a daily time frame, it was much better. So let's see. I think the market is just moving away from our support, trying to go a little bit higher, but it seems to be struggling. If we check nicely around that level, around this level, there is an area that we can call a resistance. Do you see that? So around this level, I think it's where the market might just play around. And remember, Trump just won. Obviously, you want to pump more oil or enough oil. So if maybe there is too much oil in the market, obviously we might see a nice sell. Not maybe now, but in the coming months or weeks or whatever. But at the moment, the market is just moving away from the support around 66. So this is another area. If we break there, I think the market will be trying to reach this level around maybe 77, 78. Let's say between 76 and 78 before maybe we see another push to the lower side. Or maybe the market might try to break out. If the market does that, that will be good. You see, because I saw this company, Saudi Arabia company, that produces oil. I saw they missed the profits targets, so maybe that's why we saw oil. It was going actually lower. You see, so on gold, I think gold might still try to reverse, going higher. But in the long term, I think it's not gonna go higher forever. One way or another, it has to reverse. So let me check that German 30 or German 40. Gold is not gonna go up forever, guys. Things are going to change, especially when we have a new president in the US. They have their foreign policy, or his foreign policy might actually differ from what we had from Biden, and that might be good or maybe that might be bad. So we'll just have to wait and see. But it seems like the market is thinking positive about everything. So on German 40 or German 30, it shows us that the market has been going up for quite some time, but I don't really like what I see on a daily time frame. So I rather go on a bit smaller time frame, like 4 hours. It's not really a smaller time frame, but it's reasonable. So I think if I can draw something there, it makes sense, and it shows me that the market actually broke out. The market just broke out here, and we have this confusion. We know very well that Germany or German companies are not performing very well. If you check the news, VW is not really performing very well. They are firing their employees. They are closing some of the companies, VW. So German companies. I think one way or another, slowly we will see some reversal along the way. We can see that the market was going up. Obviously, we had a breakout, but it seems like the market is still playing around. We can mark this level. You can see that it's a support, a very nice one. So another one, it will be here. Then if maybe the market breaks our resistance, we can say, okay, the market is trying to continue with the previous uptrend, you see. But at the moment, since we had a breakout, it seems like the market just wants to play around. So we just have to relax and see where the market is going. If the market breaks this support area, we can say it's good time for us to look for that sell. But at the moment, I think it's good time for you just to relax. Some they might scalp, but the direction is not really clear. So you have to wait for the market to get out of this ranging structure before it start to move nicely or before it start to trend. So at the moment we have two options: whether it's going to go up or down, we don't really know. But what I know is German companies are not performing very well. Things are not looking good. Let's say actually in Europe, most companies are not doing well. Chinese are here to, they are not here to play games, you see. So let's see the other one. US oil, German 40, 100 silver. Guys, sometimes on this on the silver part, I think other things I'm not gonna check them much because I don't really know them. So trying to go through them and seeing some stuff, it's not really good. It's not really good. So I have to say some stuff that I understand and or analyze things that I do every day, or else you end up lying. You see. So on gold, I see someone who asked about gold. Gold, I think we are still trying to reverse here, but I am not confident that we will see a continuation of that bullish momentum for a very long time. If you check nicely, we had this bullish momentum for a while now. So if we go back, you can see this thing's been like seriously flying. So one way or another, we have to offload this profits. We have to offload this markets. So yeah, I think I don't really see much here on gold. But even if whatever that I'm saying here, I'm not expecting a too much push to the upside. Still, we have to follow what we see. If technically the market is telling you that okay, we still continuing to the upside, there is nothing you can do. You just follow the trend or you follow the market structure. Because sometimes you can think about all the news, think about everything. You might sometimes not even trade because there will always be something happening. But the best thing is try to check your technicals. If you get everything right, if everything confirms, why not? You just jump in and do you. So that's what I see. That's what I see on gold. So US 100. On US 100, let me check US 100. New Zealand bond, ZN bonds. ZN bonds, unfortunately, I don't really check them much. Any pair that you want me to check, guys? I think I already checked everything. So let me go maybe on something else. GBP, USD, especially during rates cuts. What are we going to get during these rates cuts? I think the market will try to reverse. I think we're going to see the market trying to push to the upside. I think we are going to see the market going even higher. We had a very nice uptrend on GBP USD, and I think the market already started to price itself to the news. I see a bold bullish candlestick, so which means yeah, buying here it's good, but it's a little bit far from our support area. So this is what we have. Let me draw this properly or nice. It's supposed to be like that. It's supposed to be like that. Yeah. So this is what we have on USDJPY. We have these areas. You can see they connect very nice. So obviously, I'm expecting to see a very nice push to the upside. Plus, you can see here we have some events coming. So obviously, those events coming, there will be obviously pushing the market to continue with this trend. I'm expecting to see a continuation of that trend. So another pair, I don't know if maybe I'm not over using my time here. I think we have like almost an hour now. Let's see. Tesla, US 100, German 40, US oil, silver, GBP USD. Okay, I'm doing GBP USD now. Any other pair? But I want to hold gold long for 50 years. Okay. So GBP USD, yeah, I'm expecting to see a continuation of that, but be extra careful with this resistance. We had a resistance here. It's been there. The market has been respecting this level. So you can draw a proper line there. Let me draw that for you. Let me draw that for you. So I think if the market breaks out of that, that can be a very proper buy. I think this can be a very proper buy structure. Let's see. Something like that. So we can draw it like this. So we can say for us to be safe, because if you check nicely, the market has been respecting this since October, you can see. So the market has been respecting this level, you see. So you can't just jump in and say you're buying, because we already have a resistance on top. What if the market continues with a similar structure? So it means for us to look for a proper buy, we have to understand that the market is actually giving us a wedge structure there. So the best way is to wait for the market to break out. Then we can look for that buy. Already we understand that we are on an uptrend, but with this type of a structure, we need to wait a bit before we see, before we jump on a buy. I hope uh, I hope that it's actually visible on your site. I can see. Feel free to go as long as your likeness on it will be ready when you are. Okay, okay. Yeah. For now, I also have. I will check maybe few pairs, because I think I have a session in less than 5 minutes, so I can just check a few pairs, maybe two pairs. Any pair that you want me to check. Gold, I think I repeated gold several times, guys. Okay, let me repeat again on gold. It seems like everyone is interested, guys, with gold. So on gold, we saw a nice reversal yesterday. So that reversal, it was like quite aggressive. Those type of moves, obviously, the market will tend to recover that very quick. But once the market recovers that, it doesn't really mean that the market is forced to go even higher. The market might recover that, maybe reach this level, and then after the market start to continue with the proper sell, because that was like a meltdown. So mostly the market doesn't really like something like a crash. If the market moves like this very quick, one way or another, the market will try to recover before going slower. The market likes to go slow. So on gold, as I repeat, I think US economy is going to perform very well. We can see from the Nasdaq, from US 30, Russell, S&P 500, they like Trump. Obviously, Trump is pro-business. So that actually is going to boost US economy, and that is going to increase activities in the US economy, right? That is also a number one bonus. So which means that will make the dollar to be desirable. Uh, Obviously, people, they will be starting to buy some bonds and stuff like that, and that will have a weight on gold. Another thing is, Trump, obviously, he mentioned this several times, that he wants to end wars, so he doesn't want any war. So that is actually good, but not good for gold. Gold likes where there is tensions, where there is geopolitics. So mostly we use that as a safe a haven or as a safe where you can actually have your funds, because maybe situation is not really nice, geopolitics are all over the place. Then we use that as a neutral where maybe we can use it just to save our funds. But when the economies or when other economies are performing very well, there is no point holding gold. You can buy stocks that actually grows where you can make money consistently. There is value stocks, there is growth stocks, there is dividend stocks. Then it's good time for those investors who were buying gold to actually uh, buy those stocks, because gold doesn't really have any dividends. You see, if it reverses, it loses that value, and it seems like we will see that. I think we will have to see a nice reversal. But another thing that is a bit confusing is, uh, as we have these rate cuts coming, obviously also gold, it will be also a very good asset to buy, alternative to USD. So which means we just have to wait and see. And but along the way, one way or another, we will see gold going down. At the moment, it might push up because maybe the rates cuts and stuff like that. But once time goes on, we will see war coming to an end, or maybe we will see some resolutions, and that will help uh, gold to actually start to decrease this momentum. We will see the loss of this momentum. It's not going to continue forever. So for now I think it's enough, guys. I also have to rush to another session. So thank you very much. I think I will see you on the next one. So yeah, let me just wait for Nick.
Hey Kenzo, I'm here. Hold on. Let me switch this around just for a second. Thanks for coming on, Kenzo. Appreciate you coming on here. And everybody who's watching, if you guys enjoyed that great commentary from Kenzo, especially the breakdowns on gold and stocks and all of that, make sure, guys, if you have not already, go subscribe to Kenzo. He's got his own YouTube channel, puts out great free content for traders out there. Kenzo, you got to rush off. I appreciate you coming on and helping us out with the show today. And we will see you on the next one.
Thank you very much. And also your viewers.
Perfect. Thanks, Kenzo. Again, guys, do us all a favor. Go take a minute to subscribe to Kenzo's YouTube channel. That is at Extra Hot Forex on YouTube. And we're counting down the minutes here, guys. We've got, well, I guess still about 2 hours, but we've got the Fed meeting coming up. And there's just a lot going on. The markets are going crazy. They're going just wild to the upside. We're seeing a little bit of a melt up right now, and there's probably an understandable amount of FOMO in the room as well. The Nasdaq is absolutely ripping to the upside here. Dow Jones also taking a pause here today, but I mean, just look at the Nas. Tech stocks, I mean, we could look at let's see, we could pull up the heat map here. You've got just a ton of big tech names jumping here this afternoon. Meta is up 3% today. Like, what is going on out here? You've just got mega bullish moves happening all over the place. If we filter by stocks, I mean, wow, look at Elf Beauty up 18%. Meta's up 3%. Tesla's up 3%. Airbnb's up 3%. Fortinet's up 2.4%. Costco up 2%. Apple up 2%. Google up 1.8%. Nvidia's up 1.5%, following a day yesterday where they were up 4%. I mean, I've not seen this kind of rally since 2021. And I'm not gonna lie, it feels like 2020, 2021 right now. The scenario, the conditions that we have for, stock market run are sort of there, right? You have inflation that's really come back a long ways from where it was. You've got company earnings doing pretty dang well. You've got the Fed that seems to want to cut rates, with some updates on that coming shortly. But my point is, you have a lot of scenarios that favor upside moves, and of course, the Trump trade is part of it, because under Trump, businesses made bajillions of dollars, and there's probably some excitement there. Specifically, one sector that I've referenced a couple times is the financial sector, which has jumped massively as of yesterday, because again, this is the less regulation stuff, like less oversight from the government ideas. What that does is it makes it so that companies can IPO easier. They can buy each other easier, right? Less restrictions on that front can allow companies to merge and acquire other companies easier, because there's less, oversight, governance, etc. Not to say that there's none, but there may be less. Businesses like banks, which facilitate IPOs and things like that, are going to love that, right? So pinking XLF as a sector was up 5% yesterday, which is nuts. Chinese stocks are up here today. Gold is up again today, 1.4%. Gold's a tricky one because, on one side, when you're looking at gold, there's the bullish case of saying, well, Trump is a wild card. We don't know what we're going to get from him. Let's hope, regardless of how you feel about the guy, let's hope that he is successful in stopping wars. We don't know. He may not. Let's hope that he does, for the sake of humankind, regardless of how you feel about him. I hope that there is less war, and that's, I think, a lot of people's hope with him is like, is he going to actually be successful in that? And again, for the sake of humans, let's hope so. But that being said, Kenzo made a good point there towards the end of his presentation about gold basically being likely to fall if there is success in that front, right? If things resolve in Eastern Europe, in the Middle East, in any capacity, gold would likely go down, simply because gold has trended up so much this year off of all of the uncertainty in those parts of the world. So we'll see. That's sort of an ongoing story. We don't have clear answers on that front. But then, what does make me also a little bit cautious about gold is you just have a lot of economic data that is leaning more towards things are okay right now. Right? Look at gold and we can see, let's actually do this. Let's filter categories just for metals and take a look at gold and silver, right? Take a look at gold and silver. Some of the economic data here, services PMIs, retail sales, interest rates rising on the 10-year yield and the 2-year yield are not particularly bullish things for metals. But then you had GDP miss, manufacturing PMI missed, inflation. So, gold and silver just are sort of neutral readings for me for those reasons. Interestingly, the trend filter here on the Edge Finder flipped to bearish recently. We will see if that does in fact play out. But you had these like impossible to crack upward trends going on in gold. And with yesterday's big sell-off, we'll see how markets react as we do get sort of the bounce today, whether or not these bounces from gold and silver are going to turn into sort of fade the rally moments. We'll see. Again, I don't have a position on gold and I don't really have any interest in trading it at this time because my reading is neutral on it. Do you trade the actual movement for FOMC? No, I never trade news spikes. I think that is akin to gambling because spreads go crazy and you are when you are trading the actual spike, your brokerage widens spreads substantially. So the only way you make money trading news is, number one, if you're right in the direction, and number two, there's such a massive news that it overcomes the huge spread that your broker puts on the trade. which is why most people think they're smart when they trade news spikes by putting buy stops and sell stops. A lot of people who do this, what they'll do, for example, is let's say you go on gold on the 15-minute chart and you get all fancy. You say, well, I'm going to, we know, let's say it's an NFP report coming out. NFP is going to either shoot way down or shoot way up, right? And if I just put a buy stop here and a sell stop here, it's going to be free money, right? It's a good idea, right? On paper, it sounds good in your head because you're like, if I were just to buy here or sell here and it was a big red or huge green candle, then I'm just going to be able to cash out right away, right? I could just short here, cover right here, make money, or buy here, close right here, right? The issue is that what happens is that when you put these buy stop orders or sell stop orders in the market, I'll show you what happens. Let's say that the market tanks on gold on an NFP report or something. All of a sudden, ginormous downside move. The tricky part is that you short here, you put a sell stop, right? That means sell me at the very next possible price if the market closes at or below the sell stop order level, right? That's what you're saying. You're saying, fill me in the next available short position right now at a sell stop. So what happens? Well, what happens is that, again, you're sending an order to your broker saying, fill me ASAP if we cross there. The definite trade, the part that people miss is that your broker widens spreads during, and this is not predatory, this is just businesses covering their butts, right? Brokers don't want to just instantly take the other side of that trade for you because that would make them lose money instantly, right? Instead, what they do is they offer you the next available price, which may not be until you get way down here. So you short the market with a sell stop here, but you actually get filled in a sell down here. Now, you can still make money if the market actually follows through, but rarely in an NFP report or a CPI report is it just a straight up ginormous endless downward candle or upward candle. In fact, most of the time what happens in actuality is you say, okay, I want to put a sell stop order, fill me at the best possible price if market hits here. And then the yellow line is, so you get filled here in a sell position, right? And that is the next available price. But what happens is this, it shoots down here and may never even actually go past that level. You may just get filled at the worst possible price because of the spread, and then you're instantly in a big loss, right? The only scenario where this actually makes money with sell stops and buy stops on the news is when you get something like this, just a absolute meltdown candle or rip your face off rally candle. And those are rare. Those don't happen that much because usually the market sort of has an idea of what's going to come out. But sometimes when it's just absolutely very different from expectations, those are where you get the ginormous green or red candles. So yeah, it's one of those things. Trading the spike, in my opinion, is a fool's game because you're going to be hoping and praying for a move that is rarely ever going to happen. So in that case, then what is the solution? Then what do you do? Well, I don't trade the spike, but I trade the 4-hour, the daily chart trends that are happening. So for example, like I'm long the NASDAQ right now. And when it comes to FOMC here, if the Fed has something to say that really turns the music off at the party right now, it will probably come down and I'll stay in the trade unless you break support. If you break support, then I just close the trade. Now, the Fed may also just say, hey, we're still going to stick to our plan to cut rates several times next year, and we just continue to see this rally proceed. I don't know what the Fed is going to say today. However, the bond market is saying one thing that makes me a little bit nervous, which is yields are trending up, right? they trended up the last several weeks, and they spiked higher yesterday on Trump's victory. Now, them spiking up is the bond market saying inflation problems may persist, which is fair. Again, whether you like Trump or dislike Trump, the tariff situation is an inflationary question. And at the same time, it is fair to say that most likely Trump is good for stocks, right? In the short run, from the pro-business and less regulation side, that's traditionally seen as a very positive thing for stocks. But for the inflation side, that's the big question mark with Trump that we've got to kind of now filter into our view. And are they likely to be inflationary? Well, economists say so, and they're smarter than me. So probably. The question is, does that kill the stock market? And does it bring us to in danger territory inflation levels? And that's where things get more interesting. Because if you get higher levels of inflation from the tariffs, but then you also have oil prices down because of increased production of oil, that could counterbalance some of that inflation, right? Lower oil prices, lower inflation, tariffs, higher inflation. Who knows where it lands? Maybe we just stay around current levels, which would be relatively okay if you have the economy pick up. We'll see. You can kind of hope for the best, and where oil prices go are very important as well. What you don't want to see, you do not want to see oil prices start to spike, right? That hurts the inflation story for everyone. Oil prices staying where they are or going lower would help the inflation story. Volatility has really just fallen out of bed here recently. You can see a ginormous drop in the VIX. I think that was probably just a lot of pent up uncertainty about how the election would go, whether there would be a concession of the victory one way or the other. Last time around, there was a lot of drama around that caused some fear. And I think that, the VIX was up for that reason. The VIX has now come down because, there was a concession yesterday from Kamala Harris. And now we're just sort of, we have an answer, right? And the market just wanted to see an answer. I do stand by my thought process on the idea that if you had seen Kamala Harris win, I think the stock market also would have gone up. I don't know that it would have gone up as much simply because of all the deregulatory stuff that the market loves. But I do still think it would have gone up because the market just wanted an answer on the election thing. What would have been terrifying for the market and for gold to just, take out the highs, in my view, would have been, we don't know who the president is and they're both claiming it. That would have been scary, right? So yeah. What if you trade the news but only risk 1 or 2%? Well, I still wouldn't trade the news because it doesn't matter what percentages. I still think it's a losing bet to try and make in terms of trying to get in and out on the spike, which is so spready. I think the same principle applies to what I said earlier, regardless of how much you risk per trade. I just think it's a trade that I don't want to ever make. Actually, years and years ago, I programmed a robot that would trade news spikes, and it went really well for a little while, and then it gave back all the profits and more because the spreads it works really well. Buy stops and sell stops on the news work really well when you get ginormous candles. Every other time, you lose money. It's basically like buying a call and buying a put at the same time. What is that called? Is that buying a strangle on the options market, where you basically say, I'm buying a call up here, I'm selling, I'm buying a call up here, and I'm buying a put down here. You're just saying, I will make money if the market moves massively one way or the other, but you will lose money in the instance that the market does not go decisively one way. In the options world, I believe that is buying a strangle, is what they call that. I'm not an options. I trade one simple strategy in the options market, which is the wheel strategy. I sell cash secured puts and I sell covered calls. And I forget all the fancy namings for things, but the idea is trading the news spike is very similar to buying a call and buying a put on either side of price. If you're familiar with options, then I hope that makes sense. But I only realized that, years later of when you're paying the broker a big slippage spread, that is essentially the options market equivalent of paying premium to buy a call. Straddle, is that right? Is it a straddle? Let me look it up. No, I think it's strangle. Yeah, it's strangle. So this is in options world, right? So I was right. It is the long strangle. What you're doing is, so you want markets to move one way far or the other. The long strangle is where you are buying a put below current price, buying a call above current price, and you make money if it moves in either direction very decisively. But you lose money. You can see the red area is where you lose money. You lose money if the market doesn't go anywhere, right? Because again, then your long call expires worthless and your long put expires worthless. Gold's having a real strong bounce here today, which is interesting, up 1.5%. I'm still very neutral on it. I'm positioned pretty heavily in the indices at this time, and just trying to just trail stops and not do too much. Sometimes when it comes to like melt up rallies, like I think we might be seeing, like Bitcoin jumping up another 0.77%, I've just got my stops trailed on these things, and I am trying to do as little as possible, which is what I've found in these sorts of market moves where you get these ginormous risk on rallies, right? Stocks are just taking out high after high. It's very tempting to try and realize these profits, to try and close these winners. But it's really important for my trading style, which is, I trail stops and I follow fundamental trends. Right now, I see fundamental trends pointing to bullishness for indices. Like that's the move, that's the trend. Momentum favors the bulls here. So I'm trying to do my very best to actually do nothing at all, except for trail a stop. These are the windows in time where most of my gains come from in the markets. What ends up happening for me in my trading performance is I usually have, this is what my trading performance typically looks like. I have these very sharp, intense gaining periods, and then I have losing streaks or sideways performance, and then I have another really big hit, and then same thing, losing streaks, big winning periods. This is typically what happens with my momentum trading style that I employ in the markets. So right now, I'm feeling very grateful to be in one of these periods. But they're rare and they're short-lived. I'm long some really crazy moving positions. I'm long the semiconductors ETF, SMH. I've been trading this a lot this year. This trade's going crazy. Now, there's times where I lose, $5,000 or $6,000 7 times in a row. So please understand, when I'm showing you a good trade like this, there are times where I'm entering, like, for example, I took losses before this one. Like I believe I took some trades here, right? And then stopped out, took another attempt here, and this one is working out. I've also got the Qs, which is the NASDAQ. I'm long. This one's going absolutely parabolic right now. But again, there are times where I take losing streaks where I lose $4,000, $6,000, $5,000, $3,000 in each trade, and then I capture the runner. It's kind of like paying the fees, right, in order to finally get to a trade I've been looking for. So the NASDAQ, the S&P, Dow Jones, all these things I'm still very bullish on. I'm just trailing stops and trying to not get my own way here. Because again, when I mentioned that with my trading performance, it's typically sharp moves up and then periods of drawdown and boringness and losing streaks and then sharp moves up. The worst thing I could possibly do would be to cut short one of these periods. Do you see what I'm saying? If I cut short these trades that look insane, like I'm like, oh my gosh, $20,000, that is insane. But I have to remember, I paid a lot of money to find this trade. Many times did I take losing trades of several thousands of dollars. I am also, disclaimer, working on a larger capital basis. And that should be said because I'm not out here doubling my account or being, ludicrous. The risk on this trade was much less than $20,000. It has become a big winner. But again, I pay for these big winners in my losing streaks that inevitably come in between the big win periods. Does that make sense? Type yes in the chat if what I just explained makes sense about trend following 101. When you trail stops like I do, most of the time, my trading looks silly. Most of the time, the market makes a move. I look for a pullback. Okay, I'm in the trade. And then I stop out. And then, I look for another trade and then I'm in, right? And then I stop out. And then finally, I catch a trade where I'm in and it goes and then it pulls back and I trail my stop loss and then it comes back. And then I took a small win. And then finally, I catch the right trade that does this. Finally, I catch the move, right? So my point is, when you see me having a trade like this, I don't want you to think that that's like an everyday thing because I am not that smart. I wish that I always had trades like this. I pay for trades like this with losing streaks, drawdown periods, and losing multiple thousands of dollars at a time on some of my positions. Now, the reason I'm disclaiming that is because sometimes people see these, social media people, and I know the dangers of only showing your winners. I do my best to show you when things don't work out too, because I took a couple $1,000 loss yesterday on XLRE, which is a real estate ETF. I had a long position right around here. Yesterday, I stopped out and it bounced, which kind of stinks, but I lost a couple grand on that. So, just wanted to add some context there. I also went through almost a $100,000 drawdown this year between the months of August, July and August. Yeah. At one point in August, I think my peak drawdown for the year reached about 11 or 12% on my portfolio, which came out to around $100,000, which is the largest drawdown on a nominal basis that I've ever had, but not on a percentage basis. So I do like to discuss this topic because it's important for clarity and transparency that I'm not only ever talking about when things are going well, because they do not always go well. And we're in a bull market year. I typically make more money in bull markets, and in bear markets, I suffer and cry. So context is really important. I call those noob fees. Yeah, me too. I don't call them noob fees, but the thing is, you just sort of have to like pay for the false starts. Like sometimes people ask me the question, they say, Nick, how do I avoid a false breakout? I'm like, dang, if you find out, you let me know, because I need to know how to avoid false breakouts. They're just going to happen sometimes. And the second you sort of start to say, okay, I don't need to worry so much about getting the perfect entry. I just need to be watching trends. I need to stay aligned with the general market direction, find good opportunities, wait for pullbacks, manage my risk appropriately. I mean, I've been trading this NASDAQ idea for most of the year. I also traded gold a lot this year. And I did not play them perfect, right? So gold this year, I've been predominantly bullish, but I've missed this recent rally. I had several great trades this year. I also had periods where I gave money back to the markets, gave money back during this time, made a lot during this time, completely missed this time. The cool thing is, and thank goodness for this, you don't have to be perfect to make money in the markets, but you can't try and make quick money in the markets. That is where people lose. Because what I discussed here, right, with those losing streaks, the only way I get to that next good period in my trading is if I survive these periods. And oftentimes they can be long, cold, lonely. There's tears mixed in, right? And so for me to be able to make it to those next big moves, those next finally trades, basically, I have to save enough tears to survive the drawdown, right? The only way you do that is you risk small. You don't risk ginormous on the trade. Now, I know you might say, well, Nick, your positions are big, but they weren't always this big. 8 years ago, my positions were 0.01 lot sizes, right? Anyways, I do want to just remind you here, we're going to have our next guest come back. He's for a second time. It's the encore. FOREX James coming back to the show here for a little bit, take over as we count down the minutes to our Black Friday, to our big event here today, which is the Fed meeting. I do also want to remind you of the Black Friday sale on the Edge Finder and our VIP group. Both are 40% off right now. You can use the promo code that's in the description down below. And if you have any questions, please speak with a member of our support team right here. We got that link for you in the chat. You can speak directly to us, get some information about the sale, the discount info, if you want access to the Edge Finder, etc. All that good stuff. We'll be right back with FOREX James taking over the show for a little bit just after this.
Looks like we're receiving a transmission. I think it's an alien, which is pretty cool.
Okay, all right, I'll go check it out. Beam me up. Whoa, hey guys, I come in peace.
Hey, you're back. What happened?
Well, they gave me this.
The A1 Trading Stock Box, an advanced market scanner of top stocks, ETFs, insider trades, and analyst ratings. Unbox smarter insights and discover opportunities with powerful data at your fingertips. Get your stock box today with our out-of-this-world Black Friday sale happening all month long.
See ya.
See you later.
Hello again. So we've got just under an hour and a half until we have the Fed rate decision. I wouldn't expect the rate decision to really have much of an impact, to be honest. The 25 basis point cut is already priced in. I've heard some people say they're not going to cut. So, you know, there is an expectation on sort of social media that we'll see a rate hold, which I don't really think is going to happen. So if we go ahead and have a look at the, where is it? The Fed Watch tool. So we can see, yeah, so we've got 99.1% probability that we'll have a 25 basis point cut, which, you know, I have been saying for a while, though I'm not trying to say that, you know, I predict these rate cuts, but it was quite obvious. Obviously, I'm still speaking without it happening. So maybe, you know, maybe in a couple of hours, I'll look like an idiot. However, you know, since we had the previous previous 50 basis point cut, the data for the dollar has been very supportive. I mean, you can see that within the price action. The labor market has definitely picked up. I mean, obviously the NFP on the start of this month was a bit of a letdown, but overall, I think we're set for a 25 basis point cut. So back to the point, I don't think we're really going to see much of market movements. Where the movements might come in is in the Fed press conference afterwards. Now, what that will do is give us some more signals towards, where is the Fed heading next? What are they thinking? How do they view the economy? And how do they view the data? I mean, it wouldn't surprise me if, they've got the thing of saying, oh, it's, data dependent. We can't give you too much information. So it's, might just be a snooze fest, but it's worth a watch. Will the Fed cut cause indices to go higher? Probably not. As I said, the rate cut's already priced in, so it's not going to be a hugely volatile event, I don't think. The only sort of situation I could see this really being a market mover is if we see a 50 basis point cut. That would be quite detrimental for the dollar. Because that's not priced in. People seem to be expecting 25. So if we got 50, that would be a case of, oh dear, we need to get out and start selling the dollar. If we see a hold, that might be a very bullish situation for the dollar. However, 25 basis point cut likely won't be too crazy. We might see some bullish movements, but again, not hugely. So 50 basis point cut will cause more volatility. Absolutely. So a 50 basis point cut would cause the indices markets to start rocketing even higher. So I'm still in my euro dollar shorts here. I can show you that here. So far, very boring day, sort of just adding in these positions and sort of building it up. So there's nothing really for me to do. Again, the Fed cut doesn't bother me. I'm not too concerned about holding into that. If we do see euro dollar start rising, then I'll just add in some more positions. It's no big deal. I was also watching dollar yen. The setup here looks quite good. I'm not going to take it because I'm already in euro dollar. So I'm not, I'm not looking to overexpose myself within the dollar. But we do have quite a nice 50% pullback here, along with this 200 moving average and the RSI oversold. So yeah, technically does look quite good. And fundamentally, I'm still bullish on this market. It's just right now, it's probably not the best time to get in. James, the market wizard is back. I wish I was a wizard. Okay, thanks. I've noticed it has been quiet. I guess the market is waiting for Powell to speak. Yes. Yeah, you'll see reduced liquidity or reduced volatility. Until the Fed press conference is done, really. So yeah, the dollar actually did show some signs of strength earlier. So if we look here on the H1, we had one bullish candle, which was quite nice. But it doesn't seem to be leading to too much. Can you speak slowly? I'm not good in English. I'll try to speak slowly, yes. But what we can see is as soon as we've had, I mean, you can't really see it through all these annotations, but as soon as we had the elections, the dollar has started moving to the downside. Is it going to be the same situation we saw here in 2020, where we had the elections followed by a move to the downside? Similar thing here in 2016. So this was when Trump was elected in for the first time. We did see quite a nice run here of 5%, followed by a 14.25% move to the downside. Here back in 2012, we had a 2.64% move to the downside, followed by 5% gain. So yeah, I mean, the pattern isn't, well, there isn't really a pattern, to be honest, especially from just the, the recent data within the 2000s. But, we can do what we can with just sort of a brief look. So we'll see how the dollar reacts over the next, well, I guess for the rest of the week. Your take on euro yen. Let's see. So yeah, we were speaking about euro yen earlier on the stream. There's not too much here for me at the moment. We are seeing price respect this level of structure that we've got through here. What was previously resistance, we've now broken above. We seem to be sort of retesting this level. What puts me off this market, though, is the European Central Bank. I'm not really a fan of buying the euro right now. So, I'm quite, relatively heavy short on the euro. So yeah, whether I want to start going long on euro yen, possibly not. We are sort of we are technically in a central bank divergence with the euro and the yen as well, with the Bank of Japan looking to hike rates in December. We've got the European Central Bank cutting their rates quite aggressively. So a bit of a discrepancy there. So it's not something I'm overly excited to start buying, but yeah, if we had to take a trade along, would make some more sense than a short. We have to pay the price to reap the rewards. Absolutely. I believe gold will thrive off interest rate cuts. Well, it depends how much of an interest rate cut. If it is just the 25 that's expected, I wouldn't really expect it to have much of an impact. I mean, gold has almost fully recovered this move from yesterday, which is good. So yes, maybe the interest rate cut will give it that extra bit of juice to just finish off this bullish move for today. But it wouldn't be, again, I don't think it'll be a huge market mover. Fed rate cuts are almost completely priced in. What do you think of gold price after Fed rate cut? If it's 25, possibly, yeah, it might give gold, like I said, enough juice to correct the full move from yesterday. If we did get 50, which I highly doubt, but it's better to be on the edge of caution than be sort of a sleeping on the news, if that makes sense. If it is 50, then possibly a move up until 27.81, possibly even higher, maybe to new all-time highs. Steezy, my name is James. I'm not Nick. So let's. I'm just trying to have a think. I kind of gave away everything I had planned this morning, so we can take this on a message by message basis. Hedge on dollar, selling USD CAD, buying USD JPY. Okay. Dollar CAD shorts are a brave move. Let's see what that's doing actually. Oh, maybe not. We are seeing quite a nice move down on the dollar CAD. It's funny, I was saying, I think it was last week or the week before, dollar CAD shorts actually make a lot of sense. I was just waiting really for a catalyst, so waiting for event trading, essentially waiting for some sort of news to come out to really give this market a reason to go down, and maybe today will be the day. But if we look on the weekly, look at this level of resistance that we're currently on. It's beautiful. It's one of those types of resistances that you don't see very often. So if you can capitalize on something like this, then great. But then, the other sort of roadblock is, if we go short here and there's not really enough to back it up, there's nothing then stopping the market coming up to the next higher, the next weekly resistance, which is up here. That again, we could short from. If we do see price come up here, I'd be quite happy to take sort of just an aggressive entry and see what happens, based just on weekly key levels, really. Which is rare for me, but in this situation, I think it's worth it. We are also seeing oil. Let's have a look at oil. Oil is actually gaining some ground, which again will be helping the Canadian dollar start to compete with the US dollar. So we'll have to see. I might take a short position on Monday. Again, I'll have to, review the data, see what's going on, have a look at the oil prices and forecasts and things. But yeah, dollar CAD short. Yeah, not an awful idea actually in my eyes. So yeah, I take back what I said. I think you've actually got quite a nice hedge going on. If FOMC is priced in, wouldn't 25 just reverse the move from today on gold? No, not necessarily, Nicholas. So when I say something's priced in, it doesn't mean that it's priced in today. So as soon as we had this 50 basis point cut, the larger market participants will then be thinking, what's the next cut? We need to review the data, what's going on. As data comes out, they'll position themselves according to what they think the next rate cut's going to be, or what the next 2, 3, 4 rate decisions will be. So it's not a case of people have bought the dollar today expecting the rate cut. It's way before that. So as soon as the rate cut comes out today, we'll then start seeing pricing in for the next rate cut if we have another rate cut. What's about silver if we get a break and retest? Let's see. Silver does look good. I would be, yeah, technically, I actually wouldn't mind going short from here for this break and retest. Obviously, we've broken down, waiting for this retest, and then a continuation to the downside. Although I'm not fundamentally bearish on silver, so I wouldn't actually take this. But yeah, speaking from just a technical front, it doesn't look too bad. Let's see. Yeah, we're coming up into this sort of fib level as well, which, yeah, isn't looking bad. However, again, if we're looking more from a fundamental basis, we'd want to see the opposite thing. So the break above the retest and then the move to the upside. So let's see. Yeah, it wouldn't be 50. Okay. So it's something along these lines. Have you guys got any positions on as we go into news? It'd be interesting. So yeah, we've got just under an hour. I'm not sure how long I'm on for today. I'm sure someone will come and pull me off. Yeah, Jovan, I agree. I don't, although the technical setup does look better, I do think we are definitely set for more bullishness on the commodities, especially silver and gold. You're short. It's 8 p.m. right now. Oh, it's at 8 p.m. Nicholas, it depends what time frame. Sorry, not what time frame. What time zone you're in. So for me, it's 7 p.m. because I'm in the UK. So you're short US 30. Let's see. That is a bold move. I understand why, I guess. I mean, if you're looking for sort of a corrective move down, but yeah, be careful. I mean, you just sold a rocket ship. So yeah, good luck. I'm not saying it won't work, but yeah, for me, that's a little bit aggressive. I'm short pound Canadian. Sorry, I am pound CAD short. Okay, let's have a look. Okay. Yeah, there's nothing I can see here really. Fundamentals for me are a little bit lackluster in terms of there's not really either way I would want to go. The technicals are just ranging. There's no clear trend here. I guess actually if you zoom out, we are in an uptrend technically. But yeah, to be honest, for me, just looks a little bit rough. Not something I'm too interested in though. What platform am I using? I am using TradingView and MetaTrader. I'm thinking of shorting gold in the H4. Okay, let's have a look. So you're looking for the fib level here. Yeah, I think if gold is going to reverse, this will probably be the area it will do it. Just be careful though, because there isn't much really for gold to go short. So if you were going to go short on gold, I would more look at it as a short-term technical play. But also keep in mind we do have rate cuts coming in just over an hour. So don't get caught in any volatility. Again, just because something's expected, it doesn't mean that's what's going to happen. We could have, a surprise rate hold that would be a bit of a shock to the markets. Hey, bro, where would you enter Euro Australian? Past indicators there'll be a pullback before it melts. Dean, it's an interesting question. So I'm not sure if you were here for my segment earlier, but I was saying that this is a position that Morgan Stanley is in. We also have, I sound like a broken record again, but the European Central Bank cutting rates quite aggressively. The Australian dollar seems to be quite stable at the moment, so definitely a good idea to go in shorts. In terms of entry, I suppose there's two ways you could do it, and it depends on the time frame you want to go for. So if you're looking for a swing trade on the weekly time frame here, I would watch for a reaction on this 200 moving average and the support level. See if you can get some sort of pull to the upside before the continuation down. However, if you're looking for a short-term trade on sort of the H1 here, you would want to see, I would want to see a pullback into this sort of 200 moving average, come meet in this sort of zone here, and a continuation to the downside. Yeah, you told me the other day I've been in since the top. Dean, that's great. Good stuff. I'm glad someone listens. Yeah, I'm a little bit salty I didn't get into this one. I saw it when price was up here, so I could have got in at quite a good level, but it, just didn't fancy taking that one into the elections. By the way, love your content. Please be more consistent on YouTube. Actually, now's a good question. I guess that puts me into a new topic. I get this a lot, and people wanting more content. But the thing is, I don't know what to make content about. So I've already made videos about my strategy and how I do things. But I'm not someone that changes my strategy every day, so I can't put videos out like, oh, new secret crazy strategy, because nothing changes. Real traders shouldn't really be doing that sort of stuff. I suppose I could do market coverage and stuff, but if there's any specifics, let me know. Can you take a look at EuroCAD? Yeah. Oh, nice. I'm not in that one. Let's get rid of all of this, actually. This reaction here is beautiful. Let's see. So I wouldn't go long. I'm not going to repeat it, but the European Central Bank situation prevents me from being bullish on the euro basically at all, other than euro yen, really. If we're looking at oil, just from today's price action, it does look like oil is gaining some of its ground. Whether that's going to be a longer term situation, I don't know. I do need to go and double check really what is actually going on with oil. So if oil does continue its gains, then a short position is actually favorable, really. So let's have a look for levels here. So yeah, I think possibly just support level down here would be sort of the first target. Stop loss is really wide, or take profit is really short, one of the two. So yeah, I wouldn't be really upset about going short off this level of resistance, but of course it depends the way you trade. Although what I should mention, oil is historically very bearish into the end of the year, and when I say very bearish, it is very bearish. So it's something you should take into account as well when trading the Canadian dollar, because obviously that will impact oil. Trump will make oil cheap soon, so might be one pump before that happens, potentially. If that is the case, then of course, like I said, the bearish seasonality of oil will also come into play quite nicely. So actually, let's have a look at some oil short opportunities, see where we could get in. So we filled the gap. We filled the gap from the 25th of October. We've got the daily. What's the brush here? We've got the daily 200 moving average. We've got resistance here. So if we could see something along these lines where we see the 200 moving average continue, we see price come up and sort of retest again. Let's see if the fib fits here. Actually, we're on this fib level. So maybe if we see a rejection around here, it's another quite nice sign. I mean, this is really messy now, but hopefully you get the picture. So yeah, I think again, this is just based on historical moves on oil. I don't think a short is really a bad idea. Dollar yen, dollar Swiss. So dollar yen, I was saying earlier, does look quite nice to go long on a technical setup for me. I'm not going to, but it does look tempting. So we do have this 50% pullback that we're currently in. We've got the RSI oversold. We've got price rejecting our 200 moving average. We've got the weekly that's bullish. The daily's bullish. The H4 is bullish. We've got the yen that isn't being held up by very much at all. We've got the dollar that is having a pullback today, but overall, in my view, it is still quite bullish. So yeah, definitely not a bad idea to possibly go long. In terms of entries, I'm not too sure. We'll have to see, obviously, after FOMC, see how price reacts from that. But yeah, generally speaking, seems fine. So guys, I've got a couple more minutes, and then I will be off. So let me just see what's going on here. However, I'm sure the market guys will be pricing it in soon. Yeah, it's probably already priced in, Dean. This is the... So I'm not sure if you guys were here in my stream earlier, but I was saying it's almost impossible for retail traders to have an edge in the markets, or a true edge in the markets. And the information is one of them. So Dean, how you said, you sure it's getting priced in soon? It's probably already getting priced in. So anything we find out late, and it doesn't matter what your sources are. So for example, I have access to bank reports, but those bank reports come out a couple of hours after they're written, and obviously they're written, you know, do you know what I'm saying? Obviously they've read that information, then written it, then sent it out. So even I get information 1, 2, 3 days after. So just keep that in mind. I wasn't calling you out then, by the way. That wasn't meant to be a hot seat situation. That was just a sort of informational tidbit. Which currency are you most bullish on, and which are you most bearish on? So bullish on the dollar, bearish on the euro, bearish on the yen, bullish on the Australian dollar. I think that's about it, really. My watch list is normally very thin. I'll identify 1 or 2, maybe 3 currencies that I'm interested in. That's it. I'll be focused on those until you know, something happens to change that, whether something comes out about a different currency or that bias then changes with a new economic release. I see something change. CME Fed Watch 98.9 cut 0.5 and 1.1% cut 1.1. Can you check it again and just make sure it really is? Yeah, we can have a look one more time before I go. James, what's your thoughts on the dollar? I would suggest the dollar. The dollar has 2 options: either now, either during the rate cuts and the conference, we'll start seeing the dollar turn back and continue its bullish momentum, or we'll see the dollar continue with some of its decline before it finds its feet and then continues up. So I'm bullish on the dollar overall. It's just, when is that bullishness going to come back? I don't know. What about that guy with God Powered Edge? Cabby, did you see my back and forth with that guy? If Nick's not back after we've had a look at this, then I'll show you guys. It was quite entertaining. Anyway, so yeah, so there's a 98.9% chance probability that we'll have 25 basis point cut. There's a 1.1% chance we'll have a hold. So that hold is still there, but you know, I'm not going to start hedging my bets for a 1% probability. It's like trying to play the lottery. What chart is that with all the currencies? This one is just the chart. So it's just the Euro index. And if you want to see the same thing, you can go onto your indexes and you can click add compare, and it adds a line chart so you can view all of them. So you can have a currency strength thing built in like this. How can you be bullish on the dollar and also bullish on gold? Aren't they correlated? Nicholas, they are correlated, but it's not a direct correlation. And what I mean by that is you will have news releases that also go from a bearish dollar to a bullish gold. But, you know, if we look at recent times, the dollar's been doing pretty well. However, gold has also been performing quite well. Now, why is that? Well, it's because gold isn't just tied to the dollar. Gold is also a risk asset. So we've just come out of elections. We've got world tensions. We've also got positive data for the dollar. So we've got one thing counteracting gold, one thing positive for gold. But those tensions and things still are weighing quite heavily in gold's favor. In a nutshell, obviously, I don't think I've got much time left here, so I had to sort of speed run that answer. Will you buy if ever there's a dollar dip? Sean, I'm already buying here. So I've already sold euro dollar a couple of times here, so I'm just waiting. When I tell you I am bullish or bearish on something, it's because I mean it. I don't sit here and spout nonsense. Or well, I don't sit here and spout what I don't actually think. That'll be very disingenuous of me. Are you going to take a trade live for FOMC? No, I just showed you I'm already in the euro dollar shorts, but I don't gamble news. Those positions are obviously very low risk on the accounts. So, overall, I'm bearish on that market. So it doesn't matter if we have a small spike. I'm quite happy to sit through it. Gold buy or sell, children's videos. Completely your decision. What does your analysis tell you? Danny, 80k possible. 80k on what? Do you mean I assume you mean Bitcoin. We can have a look at Bitcoin. But as I always say, I'm not a crypto trader. So what I say, take with a grain of salt, because I don't really know this market very well. Excuse me. So Bitcoin looks fine to continue up to 80,000. To be honest, there's nothing in the way of it. We've already broken out of basically all these resistance levels. If you're not in this market, I'd be looking for a very typical break, which we've had, the retest, and then the continuation up to 80. But, overall, just from my limited knowledge of Bitcoin, there is nothing really stopping it from reaching 80k within the next, I'm going to say the next 1 to 2 weeks. Children's videos, I just told you, why don't you consult your trading plan and your analysis? If you come to a stream for gold signals, you might want to find a different stream. Unfortunately, we don't do that here. Currently trading New Zealand US dollar, and I've been enjoying the current rally, I must admit. Yes, the dollar rally recently has been so clean. It's been, for any short-term traders specifically, it's been easy money. Bashi, good to see you. Not seen you in a while. I'm good, mate. How are you? What do you think about US dollar CAD? We've just covered US dollar CAD. Feel free to rewind, and I'll have a look at the S&P now. Wow, really good day for the S&P. I'm a little bit peeved that I'm not in any of these moves. Can we have President as a guest? Unfortunately not. I said earlier that he isn't a public person. He works very privately. Put it this way, I had no idea what he looked like for the first sort of 8 months that he worked with me. So there you go. But yeah, S&P, very clean run. I wouldn't expect the Fed cuts again to be a huge mover unless we do get the 50 basis point cut. That would be a very, very bullish thing for S&P, I can imagine. Same thing if we get a rate hold. I think that would be quite bearish for the S&P. Let's see. I am still a buyer. I'm always a buyer of the S&P. It's not something I ever sell. If you guys don't watch me often, then my general rule is that you don't sell, or I don't sell the indices. And it's just because if you only buy them, you've automatically got something in your favor. You're always following the overall trend of that market. So I would be looking very simply for the 50% pullback on the H4. Stop loss below this 200 moving average, and then just wait for this sort of retest down here and a continuation. Very simple stuff. I want something I suspect we caught an alien. Yeah, maybe so. I've got to say, some of the stuff he puts in our Discord, it's crazy. And a good crazy. I mean, I don't mean that in a bad way. Very easy money, up 300% for the last week. Also caught some good moves on the S&P. But now it's no man's land, so out of all that still retracements. You made 300% in a week. That's nuts. Congratulations. But yeah, I think the markets are very difficult really to trade right now. Yo, I've been busy backtesting 2 months after elections for the last 3 out of 4 elections to get more data, so I haven't been around. I'm glad you're well, brother. How's your trading going? Good, Bash. I'm glad to hear that. My trading's good. Thank you very much. Hello, Nick.
Hey, James. Love the commentary as always, and thanks for coming on twice today. We had we have the marathon stream today with the start at 8:15, finish at 3:30 or whatever, or 3:00 Eastern time. So crazy long stream. So I really appreciate your help just getting us through and hanging out. Also, for everybody who is here with us live, if you guys could do me a big favor, make sure, if you have not already, go subscribe to FOREX James. He's got a YouTube channel of his own. You can keep up with more commentary from him. We have James come on almost every day on the stream, just do a little session and talk some charts with you guys. So if you enjoy his stuff, make sure to check him out there. He also has his own channel or his own services that he offers over at elitetraders.io. So make sure to also check out his website for access to their Discord, things like that. James, again, thank you, man, for coming on today. I appreciate that a lot.
Cool. Thank you, Nick. Thank you, guys. Have a good day. See you later.
All right. See you, James. All right, guys. Now we're going to be bringing in a fellow A1 trading member. We got Frank coming in, so we could say hey to Frank. What's up, Frank?
Hey, Nick. How's it going?
Pretty good, man. So, okay. So we got Fed coming in about an hour. The trickiness here is you've got the market absolutely ripping ahead of time. Fed is expected to cut by 25 basis points today. But the real deal is not about today's rate cut. It's about expectations going into, December and into 2025, right?
Right. So I think the market's already expecting the 25 basis point cut, but what I think is going to be more important is the tone. And I think this is going to have more of an effect on gold. We've seen in the past, how many days? 7 days, this thing declined heavily in value back down to a trend line. I don't necessarily trust this level of support yet until we get the Fed speech. And so I think if we get if it's more of a dovish tone where it sounds like he's going to keep cutting consecutively, then I think that's probably a good sign for gold. But the other worry is that, so after the election results, I guess the market took it in a way where they expect severe growth, as we saw in the stock market the past 2 days. I'm just concerned, or I'm not very concerned, but I'm wondering if that is going to reflect in sort of like gold's price action in the coming weeks. So if we think growth is going to be heavy, that doesn't necessarily mean that rates need to keep coming down. It could mean that interest rates stay where they are, as inflation might expand or inflate rather. And then we see higher output, better jobs numbers, things like that, that would reflect a sort of inflationary environment. And that's sort of the case where the Fed should not be cutting rates, or maybe they'll feel like they don't have to.
Yeah.
And this could be extremely weak for gold, who is expecting aggressive rate cuts to save the jobs market, 50 basis points every time. Now, if we see a good recovery in the economy, I'm not super sold on the idea that gold is going to be the trade anymore.
You explained it really well, and that's pretty much how I'm feeling as well. I mean, if you get a scenario now, there are some like ways that gold could flare up again, like let's say things don't improve in the Middle East or they get worse, or Ukraine and Russia doesn't resolve. All of these things are possible scenarios where gold goes crazy again. However, that's not really something that we can easily predict. But what you pointed out, which is interesting, is that growth in the economy is sort of expected, it seems, by the response in the stock market. You're seeing this ginormous up move, and as you specifically mentioned, like growth stocks. And I saw your post within the Telegram channel, which, by the way, if you guys want to join the Telegram, we'll drop the free link here in the chat. You were pointing out that on like the financial sector, for example, financials are ripping here recently. Here's XLF, ginormous move higher. In fact, we actually got this on the weekly heat map. I saw you looking at this. Your financials are leading the way this week. You got tech stocks up as well. So some of the growth areas of the market going strong is a real good point about why, maybe gold, I'm not going to say that I think it's done per se, but maybe there are just better places to stay convicted right now than gold. Whereas you mentioned, if there's that growth in the economy, if labor market data comes in, stronger or upbeat, and we see inflation kind of stay under control, we might not see that gold rally go at the same pace.
Yeah, and earlier this year it was tech and gold. Those were the two things going higher. It was the only reason why the market was going higher for some time.
Yeah.
But then we saw sort of a shift, and more stocks are performing well. Financials are doing well. That's a good sign that we could be in a bullish environment. We're not necessarily getting, I think we are overextended to the upside, especially in the short term. But I think in terms of just price performance, seeing everything else do well, outside of tech, seeing the financials be good, that's a big one. Industrials too is a big one, and consumer defensive is very muted. So that means people aren't piling into risk averse stocks. People are going to risk on sentiment, and I think this is more of a bullish sign for the market than it is for gold at this time. And the Fed will help sort of define that today from what they say. If they say they're going to keep cutting, I think that's going to be really bullish for the stock market. But if they say they're going to have to watch and maybe pause a couple times and see where inflation's at, see where jobs are at, which is likely what they'll say, I think we won't probably see these returns that we've seen the past 3 days, but I still think an uptrend is there. The only problem that I could see us running into is if they say we might run into an inflationary issue and we might have to cut, or we might have to hike rates again. I think that's the big
and I think if we take a look at like the 10-year yield, for example, here, this is something interesting to your point about the possibility of hiking rates. The bond market is still, it's not in like danger territory per se, to the point where we would hear about like hiking rates. But you do bring up a good point in the sense that if you get, inflation really flaring up again, and let's say the jobs data just sort of goes haywire again, like really strong, it could lead into an environment where the Fed does need to pause first, right? They would pause the rate cuts first. And then if there's still no signs of cooling off, then they might have to go back into the territory that we were in 2022 and 2023, which is the prospect of hiking rates. Now, I don't think that's really where we are likely headed at this time, but it is worth keeping an eye on. Keep an eye on the 10-year yield. If you start crossing this level here, I think that's where probably the Fed says we might need to wait on rate cuts. And if it starts taking out these highs, you might even start hearing about the prospect of potentially hiking rates if we don't get this under control. So, and those things are scary to the markets. And the question is too, what do oil prices do? If oil prices stay relatively low, that helps the inflation story. But if you get a flare up in oil prices, it could drag the 10-year higher. In fact, there's a real strong correlation between the 10-year and oil prices, which I thought was really interesting. I recently did a little check on that. And if you actually do, yeah, it's really interesting. Like if you pull up, in fact, let's just do it just because we have time. If I take a look at oil and I compare it to the US 10-year yield, check this out. Take a look at the daily chart. Actually, the weekly chart might be easier. So, and then let's do a like 100 week moving average. You can see there are periods of time where it's very, very correlated, like 2021, 2022. There are some periods where it loses that correlation, but generally speaking, it has a more positive correlation than negative one. So rising oil prices cause a rise in inflation and hence a rise in yields, and falling inflation or falling oil prices causes a potential fall in inflation, etc. So just kind of an interesting thing to keep an eye on.
Yeah. And I'm looking at the 10-year. So yesterday we saw it rising, and that's what hinted for me that maybe the market's expecting less of a dovish tone.
Mm-hmm.
So like not as aggressive as we saw, where we saw a 50 basis point cut to save labor market. Seeing it not just creep up yesterday, but shoot higher was a little concerning. However, I don't know if technical analysis really matters for rates, but I did see it came up to test a trend line, and now it's rejecting it. I think honestly, yesterday's move and today's move didn't really move us anywhere. So I think it's more of an uncertain play. There was a concern that the Fed would be hawkish, and then now it's kind of tapering off. They're just not sure what Powell's going to say. And I mean, I don't really think any of us do, other than the basic stuff where he says, it depends on the data.
Right.
And
the question I have though, Frank, here is okay, so is the Fed going to maintain their data dependence, or are they going to sort of try and front run what other economists are pointing out? And what I'm talking about specifically is, of course, the Trump tariff ideas. Many economists think that could be inflationary. So my question is, if you're data dependent, meaning you're looking at the data as it's coming in, well, we don't have any of that Trump stuff, the tariff stuff, right? We don't have anything of that to go off of. So does the Fed acknowledge those potential tariffs and what those things could mean in the future in their upcoming meetings? Or do they say, we'll deal with that as it comes, and we're not going to try and forecast any of it? I think that they would be, it's kind of hard to say, like, which one should you do? Should you try and like forecast something that's not even passed yet and we don't know the logistics of, or not? You know what I mean?
Oh, I think they should keep it in mind. I think they're aware of it, and they are very data dependent, whether you agree with it or not. So it's not necessarily a good or bad thing. It's just what they do.
Right.
If they see that tariffs are, impeding imports from other countries or whatever, and we're producing more in the U.S. and it's inflationary, I think that's when they'll decide to act. I don't think they'll anticipate until something happens.
Yeah. That's probably a good way of putting it. Like, there's like some level of anticipation, but not too much of it, because, I made the comparison earlier when I talked about this. And you and I remember this. We were trading during this time back in 2020 and 2021. Jerome Powell got really, really roasted over and over because he kept saying the transitory. Yeah. He was like, but that was like Jerome Powell and the Fed trying to anticipate too much, right? So that's where they can get in trouble trying to forecast things where
they learn their lesson.
Yeah, it's like you thought inflation was transitory back then, and so everybody sort of was like, okay, it's fine. And then it turned out to not be transitory at all. In fact, it became very problematic and caused the market to really have a steep sell-off. So, I think that there's a careful if we're going to see Jerome Powell stay in position, not get deposed by Donald Trump, which I kind of feel like Donald Trump is not actually going to remove him, and I hope that he doesn't, because I think he's done a decently good job. If he stays in his position, I think he may not want to repeat his mistake of 2020 and 2021. And that's not me saying he made a mistake. He actually acknowledged it himself. He said, I think we got ahead of ourselves on the transitory thing. He owned it. So, I think he probably is like, okay, I'm not going to make that mistake again. We don't know exactly what the parameters of these tariffs would look like. Maybe they will be inflationary. Maybe they won't be as inflationary as people fear. We don't exactly know. And although economists are saying, yes, it could be inflationary, both sides think that it could be inflationary. We don't know to the magnitude or to the caliber how inflationary they actually could be. So you don't want to make that mistake of predicting again. You know what I mean?
Yeah, and he's got such a tough job as it is.
Yeah.
I don't think, with everything going on, I don't think he can confidently anticipate something is going to happen until it does.
He's got enough things he's staring at,
Yeah, and I think he's honestly done a really good job. It's just a hard thing to do. It's a hard thing to balance, and you have politicians probably screaming at you all the time.
Yes.
To do certain things, and all he's worried about is like the health of the economy in the long run, making sure that things are stable. But politicians want things done here and now.
Right.
And he's like, well, if we do this, then we harm this, stuff like that. I think he's going to be very careful with this. So I don't think he's going to be cutting as aggressively. If labor does collapse, though, if we have a jobs recession, I think he's going to have to. But as long as things are kind of where they're at, there isn't much need to cut. I think he's just got to kind of stay the course and let things work out.
I kind of agree. I mean, the thing is, we saw for much of 2023, the market gets so ahead of itself with calling for rate cuts. When we came into 2024, like fourth quarter 2023, I remember distinctly that in December, about 1 year ago, the market was clamoring and sweaty palms, so thrilled and excited that we were going to get 6 rate cuts in 2024. We are about to have our second one, and we only have one meeting after this. So we're not going to see 6 rate cuts this year. And you could see just how wildly excited and over, shooting the stock market tends to be. The bond market, which I think is sometimes the more practical market, the bond market with this 10-year rising, again, we can read that very simply as the bond market is calling what you're saying, Frank, which is we're probably not going to get a flush of rate cuts. We're probably going to get rate cuts, but probably at a slower pace than the actual stock market thinks. And I generally agree with that too. I don't think you get a flush of rate cuts. And I do think best guess for economists is the best guess for me that tariffs are likely to be inflationary. I'm not saying that ends the U.S. economy and that it's a catastrophic disaster, but I do think it probably pushes back on how many rate cuts we get.
Yeah, and I don't think the Fed knows.
Yeah.
So that people will ask them how many rate cuts, and it's not like he can tell you. It really does just depend. And yeah, we'll see what the tariffs do if they happen at all. I know that's one of his stances, one of Trump's stances, but there's nothing that's certain, and we don't know what the Fed will see, but we know to a degree how they'll react if certain things happen.
Yep.
So I guess that's the market for you, anticipating everything. The 6 rate cuts that never happened.
Right. Exactly.
They were just very early. And
yeah, I mean, they
obviously it bit them later on.
Like they may be, and that's the thing. The crazy thing about the stock market is even though they expected 6, didn't get 6, you'd say, okay, so the stock market probably sold off then, right? Nope, it found different reasons to rally off of that. Even though we didn't get the 6 rate cuts, well, the AI trade is alive and well, and we don't even need rate cuts because companies are making so much money. And so stock market is a different animal of its own that recently doesn't seem to want to take any breaks, which you and I are okay with that because we got some good positions running right now.
Yeah.
And let's not mess that up. I do think, Frank, that if I had a bingo card, I would totally put on there somebody in the panel here today is going to ask him, obviously about the election, but specifically about the tariffs. What is that going to do? Are you guys thinking about that? That question is coming, and I'm very curious to see what Powell has to say, because there's the possibility that they try and become more anticipatory about it, right? Maybe they do say, we're exploring that. We might, maybe they don't, maybe they do.
I mean, they'll keep it in mind, I know, but they won't. I really don't think they'll take action until something is happening.
Mm-hmm.
So I don't know. They may talk about being stricter, but I guess we'll see. One thing I did want to talk about, though, before we are done here, is Bitcoin. I don't know if you already covered it today. I'm sure you have.
Not in a few hours. So yeah, go for it.
So over the summer, Trump held a Bitcoin rally in Nashville, and he was talking about how, I guess, like, he was going to make it more universally accepted and adopted in the US.
Mm-hmm.
Even though it's decentralized, he was very adamant about doing this thing. And the fact that once the election results came out, that price flew up this much, I think is more so on the back of that rather than an interest rate cut coming.
Yeah, I think so too. He also made and I don't want to misquote this, so I'm just going to paraphrase and ask everybody to go check this for yourself. But I believe that he acknowledged that America is a ginormous holder of Bitcoin. There has been disputes on what they do with it, right? They have confiscated a lot of Bitcoin. The government has. Trump made a mention, and I saw this, that essentially he was pledging that he's going to push for them to keep that possession of Bitcoin and to basically maintain the U.S. government status as being maybe the top. I don't know who holds the most Bitcoin, but one of the top holders in the world of Bitcoin, which, Frank, 2020 versions of us, 2019 versions of us, 2017 versions of us would have been like, are you kidding me? The president is acknowledging Bitcoin and saying that the US government will be the number one holder. I mean, that I try not to get bullish hearing that, but that just sounds so bullish.
If you think about it, it's decentralized, and the only way to control it is to own the majority of it.
Yeah, like maybe if you can't control it that way, maybe you could just be the biggest owner of it. I don't know.
Which in both scenarios means that it's going to get bought up by some giant.
Well, and it's available on, I'm trading it myself, Frank, right now through an ETF, right? So ETFs are now accessible. It's almost like if you can't control it, if you can't wipe it off the face of the earth, you might as well just be the biggest owner of it.
Right.
I don't really know how all that works out. I think that right now it's just a momentum trade. I think it is it's just bursting through at the seams because you've got just some president here that has now been elected that seems soft on Bitcoin, whereas the Biden administration has not been so soft on Bitcoin. And we'll see where that takes us. I think right now there's just so much melt up energy going on, and who knows where it takes us. We have to be careful because melt ups can become meltdowns. But I think I'll leave it with this, Frank, because we got Chris coming on in just a second. Tell me if you see any other things in these couple points, but these 3 points are the things that I am watching for in terms of the cracking of the story. The 3 things are: rate cuts are still coming. whether it be slow or fast, just rate cuts are still coming. That's number one thing that has to hold. Inflation stays under control or continues to cool. Number two. And number three, importance for the stock market rally to persist is big company earnings have to stay strong and continue to be strong. Those three things are the three things that are make it or break it for me to stay bullish in general on risk on assets, whether it be Bitcoin, stocks, etc. Is there anything you would add to that list, or is that pretty much it?
I wouldn't add, but I'd say that I think that if inflation rises and we have great earnings and we have good growth in the economy, I still think that's another reason for stocks to rise. But it does set us up for, potential turmoil in the future where we will have to cut it, or we will have to hike again.
Yeah. Yeah. I feel like inflation going up a little bit is fine. Inflation ramping up, that's when, the story starts to become ugly.
No, I agree with that.
Good stuff, Frank. It's been a pleasure. We'll have you on another big stream, of course, in the coming days. Guys, Frank and I are in the same building, by the way. It may seem like we're not, but we are in the same building. We work at the same place.
We pretend like I'm the guest.
Yeah, we're all fancy.
We're really he's right across from me. Just on the
other side. Jog over and wave on the camera there. But anyways, Frank, thanks for your time. We got Chris Pulver coming in next. So Frank, we'll see you next time. Appreciate it, man.
Okay, thank you.
See you, man. All right, guys, we're going to take a quick break here, and then Chris Pulver and I are going to take a look at some markets. We got about 30 minutes to go here, so we'll get some thoughts on all of this with Chris, who I'm excited to chat with about this stuff. So stay tuned, guys. We got 600 people. Do me a favor, hit the thumbs up button. Stay tuned. We'll be right back.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
All right, and we're back with Chris. Hey, Chris, how's it going, man?
What's happening? Nice to be back.
Yeah, we got 30 minutes here to go for our second session here. We've been live all day for this big event, second Fed meeting where expectations are that the Fed will cut. Last time they surprised us with 50 basis points. It was largely unexpected. This time it's almost certainly not going to happen, likely to just be a 25 basis point cut. But the bigger thing, Chris, is not how many they cut today or December. It's really the ongoing story is how 2025 is shaping up to be. Is that right?
Yeah, I think that the big change is the market was already pricing in a quick 100 basis points for 2025, and that's been reduced to about 0.41. So, almost cut in half. So that's a big change in expectations. I think the Fed is likely going to stay on course with what they said for this meeting today, and then also, December being 25 basis points each. I heard you and Frank talking there at the very end. Look, I think the Fed will completely screw the pooch if they have to raise rates. If they have to raise rates next year, I think they're going to look like idiots in the market. The market will let them know, and so will every pundit out there. But that would be the worst case scenario, I think, for the Fed, which is they did all this stuff to thread the needle and navigate this just complete, absolute melt up, even through the election, which I do think is in a good place to be continuing. On my session this morning, I just talked about some of the biggest technicals I'm looking at would be if we hit overbought conditions on the RSI on the daily and on the weekly. I'll be a little bit cautious going into the end of this year or into next year. I mean, if you remember back in 2017 where we had every month was green in the S&P and it didn't crash until January 2018, I could see us doing something like that if we had this like blast off election move, melt up all the way to the end of the year. I think that Q1 would be at least a reality check. So just bracing for something like that. But until then, I think things look pretty good. There's clearly some, I don't know if this just like opened the doors to just throw in more money at the stock market, even though they're sitting at all-time highs. It clearly doesn't stop people from chasing.
No. And you know, Chris, it's the playbook 101. We've had this conversation like many times, but this concept of okay, now you're so you're at all-time highs. Now what? How do you trade this? You
Right.
know, I'll tell you what, just as a side note, one of my least favorite times of trading in terms of comfort levels is
Mhm.
all-time highs. I don't like
Yeah,
it. It's
absolutely.
uncomfortable and I know what I'm supposed to do, but I don't like doing it, which is basically do nothing for me. You know, it's trail stops, let good things run, but don't try and call that top because you're probably going to get it wrong. And also, keep just a vigilant eye out for the things that break the story. But I'll tell you, I like when markets are down 10%, 15%, 20%. Love that environment because then I feel like I can shop, I can get some discounts, I can find what I want to be positioned in, and it's an active process. I think that as traders, and you know, Chris, I'm sure you feel the same way, and many of our audience members feel the same way. I think as traders, we wanna be clicking buttons, we want to be doing things. And so when the markets are at all-time highs, whether it be gold if you're a gold trader or stocks if you're a stock trader, indices, etc., I think it's hard for us since we're here at the desk to do little to nothing. I think that's why all-time highs are difficult. Would you agree? I mean, I've got a bunch of positions open, but I'm just sitting here trying to discipline myself. I keep telling Frank, I said, Frank, my job today is to do nothing on the stock
Yeah.
market.
And that's difficult to do. I mean, honestly,
Yeah.
what I find myself doing, I'm looking at a trade right now that I'm going to throw into the Pulver alerts. I'm looking at a bunch of ratio spreads, Nick,
Mm,
which is I'm going to express that there are shares that I want to own, but I personally never love buying all time highs.
no, I
I
don't
did
either.
I did buy some
Good.
IBIT today just because that's a good
Oh, nice.
correlation. If we're running to 100K on Bitcoin, then IBIT hopefully reflects that and gets into the mid 50s. I'm looking at Sky West right now, which has been on the radar. It's been a bury stock for a while, and I wish that I bought the big discount we had back in August, but it's been a pretty solid one in the airline space. But we're sitting up here at 112, and I'm actually looking at a ratio spread that I can do for a income trade of $320, and I'll still own the shares. If I own the shares, I'd own it around. Let me do the math real quick. I'll give you the discount. So if I own it at 80, take away 250 on the long put, take away the 320 credit, I'll own the stock at 74.30, which from this stock dropping to 74.30 gives me around a 34% discount. Now, I'm happy to say, yeah, I'll own a share 34% cheaper when the fair market value is $394.
Mm,
So, I mean, even if I don't get assigned any of the shares, I'll still make income. I can stagger this out, maybe 2 or 3 times over the year of 2025. And maybe I don't own the shares, but maybe I make $1,000 or so without ever taking any assignment.
right.
And it can be like a half to 1% win for the overall portfolio, but it doesn't have any assignment, doesn't really give me any trouble. But I mean, if you look at a stock like this, it's like I don't want to buy this thing. I mean, it's like you look at what you typically want to trade, which is pullbacks and dynamic support. Well, that's here, right? You've got all your pullbacks in here. You get a nice little pullback in here, in here. Then it starts to get red during that July, August sell-off. You buy in here, I mean, that's where you want to buy. So here it's like, why would you buy that?
Right.
You wouldn't. I don't want to. So I'm going
Yeah,
to
and you
say
also
I'll
don't
buy
want
it.
to go outright short, you know, like you
Of
don't want to
course.
fight that monster. So
Yeah.
it's difficult, makes it trading difficult. And I think that, we have listeners who are watching all sorts of different markets. You got people out there who, may finally be looking at the gold pullbacks, but there's different markets. Bitcoin is probably killing a lot of people with FOMO who, their own rules tell them you got to have a bigger pullback or something like that. Or you're
Right.
looking at stocks and they're just clearing the highs here. It's very difficult to psychologically, but also strategically to handle yourself at all time highs. I do think that we've got the Fed meeting here today. I guess we should maybe keep that in focus here for a second, Chris. What's the game plan for the Fed meeting today? What are you looking for out of this?
So short term, all I have running for today, tomorrow is I have a 600 long call that I talked about this morning for the Pulver alert. I just bought a 600 long call for 38 cents. It's probably trading around that right now.
Yep.
But it's out to tomorrow. So I'm looking to see if we either get a squeeze today during FOMC because they don't say anything to derail the market. They don't talk it down. They still cut rates as expected. And, may the melt up continue. If that happens today, tomorrow, then I think 600 strike gets hit. That's a milestone to hit, to have the S&P check off 6,000. The futures market already hit 6,000.
Yep.
So, I mean, the futures market tends to kind of be the leading indicator, if you will. It's trading 23 hours a day. So if that hits 6,000, I think the S&P is next. So I'm just trading something inexpensive. I'm not trying to trade anything day trade wise. I mean, I took profit out of the SPX this morning. I mean, I'm staring at 23K in profit on the day, new highs in the portfolio. I don't think the Fed is going to come in and squash any hopes and dreams. I mean, this is probably they look pretty good. I mean, the Fed still looks okay. I just wonder. One thing I'm watching. Are you watching this too? U.S. election results. You know that the Republicans are only 11 seats away from clinching the House.
Oh, I've not kept up with the House. I
So
watched, of course,
Senate's clinched.
yeah.
It's 52 for the Republicans on the Senate side. The Senate's clinched, but if the Republicans grab another 11 seats, we have a red sweep. And I don't know if the market is going to react to that. Maybe it's not until, official transition of power in January, but that could be another thing where it's like, okay, we have some sweeping policy changes, which maybe it's not necessarily on the, capitalism side. It's not on the stock market side necessarily, but something could be, markets don't like uncertainty, and all of a sudden we change healthcare, or we roll back any type of CHIPS Act, or we do something wild and crazy where it's extreme. It's like the market's not going to like that. So just out there, like another potential thing that could derail this big blast off election move would be, okay, so it's not gridlock, which is what the market. You even posted this on Instagram, like
Yeah,
gridlock.
I've got the chart on my screen real quick. If Chandler should throw this up, there's your chart.
Exactly. Yep. So gridlock has been better when it's divided House and Senate. You have a much better performance overall long term. So, does that mean it's interesting how the Republican sweep is actually still better than the Democratic sweep? Although there is a common denominator. They both spend money. Like fiscal spending on both Republican and Democratic side is pretty much the same.
Well, and there's a couple nuances here with this chart that you do have to consider. People will love this, right? The Republicans will run to this and say, ha, see, all red is better. But you got to be kind of cautious with that, because the better way of reading this, in my view, is what you said initially, which is the mixed one is the best one on both sides of the aisle.
For sure.
Right? Mixed power, people like mixed power. Maybe you don't like it on your political views per se, but the stock market says, okay, we got a mix of checks and balances, and probably most things that most people want to see happen. If you get extremes, then you get, different stories. But the thing is, with this chart, it is also a caveat here, is that there's just not that actual much data here between these years. It's not like, we had a million elected officials and their Congresses with them. So there's probably some skews in data here. But generally, again, the thing that I take away from this is mixed is generally perceived as the best. So we'll see. I mean, and the other thing is, regardless of the color of the White House and Congress, all of them expect to see positive stock market years overall.
Yeah, that's what I was going to say, is if you look at just the stock market in general, it doesn't matter. I mean, we're going to have our 4-year terms and our 8-year terms, and we'll have a new administration in 2028, or it's like, so it's not going to matter. I mean, the stock market is a living, breathing expression of greed and fear. I wasn't even going to say the economy, because it's not the real economy at all.
No,
but it's probably more of the
Russell is a better indicator than the SPY for the economy, in my opinion.
That's true. That's very true. But yeah, I think it just personifies the fear and greed in the market, and just look, there's a lot of willing risk taking out now, which is impressive. But it also means that typically when people go into these late cycles and they throw everything at it, thinking it's like, they can maybe catch the end of the melt up, but they typically time it so poorly that I mean, you and I are talking about very realistic and practical ways where, look, I'm all about the melt up. I think if we get more melt up, more upside, that's totally fine.
Right.
But when I look at my technicals, and this thing has stretched out, let's say, so we haven't hit this 200 EMA in a while, and that's not necessarily the reason I'm looking to be cautious, but it's how far away we get, Nick. So right now, with this blow off move, we're sitting about 11% above the 200 EMA. Now, if you look back at any time in history, if we've stretched to like 15% or 20%, which is so hard to do, anytime we've seen a stretch like that, we start to see some reversions.
Yeah.
So that's what I'm watching too. Yeah.
It's the market does typically go up, so you take that with a grain of salt. I think it's a much better indicator on the flip side. When the market is way below key moving averages, it's probably a way more violent signal. However, to your point, very rare that we get that stretched. And when you do get that stretched, exercising caution And I think, Chris, the gates have opened as you opened up earlier in the stream. I think the gates have opened to the masses right now. We're seeing, a weird flow at all-time highs into the market suddenly and aggressively. And while I don't necessarily think that means top is in right now, you do start to have to wonder. I've been saying this. I haven't spoken with you as much recently, Chris. So I've been missing our chats. But Frank and I, off the live stream, have been really saying that it feels a little bit like 2020, and we're trying to find out where 2021 is, right? Because you got all these right scenarios that on paper everything looks pretty good. You got the Fed cutting, inflation looks okay, corporate earnings are rising, and to throw on the cherry on top for the stock market, I do think that the less regulation from the Republican side winning is going to, in the short term, be a catalyst. So you've got all these scenarios, but this is like what happened in 2020. And then 2021, we had that burst to the upside, that energy that lasted a lot longer than I thought it would. And then you had 2022, which was a really ugly sell-off if you were in unprofitable tech that was really exciting and being pumped everywhere. I was watching it every day. You were too.
Yep. I know you and I are talking about this a lot next week, but one of my big themes is flight to quality. I mean, I think it's great to have all these runners, but like,
me too.
I mean, look, if we see NFTs type stuff making a comeback or just like dirt tech and garbage tech.
I learned my lesson.
Yep. Like that.
I never
honestly,
touched that stuff, but
and that's a short-term lesson to take away because it's only a couple of years ago, but man, you could see how nasty those pullbacks get. I mean, and look, we saw a large cap pulling back 50, 60, 70%. We saw large cap quality tech pulling back 50, 60, 70%. So the stocks that have been, and so anybody that's asked me this year, hey, Chris, what about Rivian? What about this? What about like all these stocks that have been, they like Peloton, they ballooned up, hundreds and hundreds % during COVID. And now they're down 90+%. And people look at that like that's a value play. I'm like, you don't know what value is. Like that's not value because it's garbage for a reason.
Right.
Stock market treats it as garbage. It is
value,
garbage. And you're not going to get anything out of that. So that stuff I would absolutely want to steer clear of. I would go for, I mean, and it sucks to feel like you got to buy these highs, but the stuff that's quality and can stay quality, I think there's resiliency built into that. There's additional buying, like there's buying and order flows built into that. So and maybe you don't have the, I don't know. I mean, look, you're going to give up on the triple digit upside, but I'd rather have steady double digit upside for the ability to trade something super liquid. That's not like a full on exit. If the market takes a nosedive, we get these big exits. Another thing, thoughts on this. We've talked about like the leverage instruments. When you have like leverage ETFs that are just focused on NVIDIA, or somebody hit me up today asking about, some of these derivatives that are out there where you can just buy into a fund or an ETF, and all they do is they sell covered calls on a certain instrument, and it's into a fund that they pay out like 100% of the premiums go to your fund. But here's what happens. Here's what happens. You have the underlying asset that goes up, and you have those that pay out with those sell call trades. All it is selling covered calls with 30, 60 days, and but they don't have any downside protection. So if the stock market drops or the stock drops, you're on the hook for that full risk. And as the stock goes higher, you're getting those repriced and repriced and repriced and repriced, and it never actually looks like the underlying. So my 2 cents is I'd rather trade the underlying, and then I'll pick and choose whether or not I trade the options along with the underlying, because if this underlying goes up,
even with a basic level of technicals, you can wait for some oversold statuses to maybe wait to sell cash secured puts, or wait for some overextension to start selling the covered calls. So maybe you can appreciate more of the upside. Chris, I wanted to show you a chart. This is really going off of your point here. When you talk about flight to quality too, I didn't know this, but if you actually wind back the RSP versus the S&P 500, there are periods of times, long stretches of time, where the RSP has actually outperformed. Seems like a foreign language in recent years. Are you kidding me? The equal weighted ETF has outperformed the weighted stuff, which is, look at this. This is going back to 2010. RSP beat the SPY.
I just took a screenshot of that. Okay, so the S&P, I put a trade on here in SkyWest. I'm going to get that into the Pulver alerts here in a moment. So I just collected 310 credit on a trade for SkyWest that if I don't get assigned, I make $310. If I get assigned, I'm going to own the shares at around $75, which is a pretty nice discount. I think that's around that 35% that I said. That would be a 33% discount from current price. Okay, SPY. So on TradingView, you can see that the last 5 years we've averaged 92.63%. I took a screenshot of the RSP because I was curious. Last 5 years averaged 63.66. So what you go back you go out further though. I mean, what's the last? I wish there was a decade plus. It said I saw 10.9% average.
Yeah.
10.9% average
Well,
on RSP.
all I did here, Chris, is
good,
I just zoomed over to 2010 on my chart here, and you could
Yep.
see again. Now, if you go, it depends which time frame you select. Here's 2008. Actually, maybe this is better, right? Let's include the 2008 fall and look at RSP. It's still held up better on the long stretch. I just think that's very interesting that RSP, in theory should massively underperform. And it does, if you go to the inception here, 2003, it does underperform, but it's still not by that far of a margin. And this is also during one of the best bull market runs overall in the stock market's history. So
on that chart real quick, Nick, you have RSP as your symbol. So wouldn't that be the candles?
Oh, you're right. I'm reading it wrong.
Okay. Just checking. So S&P
But actually, so
close,
maybe that's still, there are periods here. You're right. RSP is the candles, but look at this. I mean, that actually maybe reverse course still proves the point very well.
Yeah.
Look at the return since 2003.
Well, this is what you and I have talked about all year, right? The market to be a healthy bull market, we do have to have a widening and a broadening. So this is a good place to consider. Like, this is why this week I bought RSP and QQQE, because I know that the rotation into quality can still be reflected with equal weighted or be reflected in the overall like ETFs. But I also look at them, they're so much cheaper, dude. I mean, the difference, look, the RSP is $183.
5 or 600 instead of the,
I mean, for your dollar goes a lot farther on RSP when it's like, okay, I've got $1,000 to spend. Well, I can buy more shares of RSP than I can SPY. If I trade $1,000 on the QQQE, I can get a ton more shares. QQQ is 93.87 and the QQQ is 512. It's no comparison. So anyway.
Well, and I think that it's during downside risk periods, you benefit a little bit from the actually even distribution. I mean, if you have a huge chunk in NVIDIA and NVIDIA has a 60% drawdown, it's going to hurt. But if NVIDIA is just one equally weighted piece of your index like RSP, then you're not going to hurt as bad. It's still going to hurt because everything will be down, but you won't be nearly as leveraged into specific, or not leveraged, but exposed to one particular.
That weighting will hurt you both ways. It'll help you and hurt you. If you're equally weighted, like NVIDIA with the gains it's had this year has been responsible for about 25 to 30% of the entire S&P's gains.
Yeah,
so that's market cap weighted. So RSP is going to be just a little bit less fluctuation on both sides where, you're going to give up some upside. But I mean, again, I look at it like if your drawdowns are more manageable, it's easier to trade, period. I mean, maybe people don't look at it that way, but for somebody that's been in this market for a long time, I'd much rather have, less than 10% pullbacks that are manageable as opposed to a 20, 25, 30% pullback. So actually, while we're on that point, let's go to RSP, and let's actually look at the last bear market we saw. So here's 2022. From peak to trough, what did this thing pull back? About 24%. Now let's compare that to the SPY.
I got your SPY coming too.
Okay, tell me what
SPY is 26%, which is not too much different.
Okay, I got 27 peak to trough. What's QQQE? I feel like the QQQ had to be a little bit better. I hope. Let me find out. Okay, that was freaking nasty. So QQQE peak to trough, I'm getting 36. Now it's not that much different, dude.
Yeah, 37, 38. But Chris, the other thing too, though, is that those Mag 7 during that time still held up relatively well compared to some of the lower quality tech stuff. That's the tricky part about the.
That's true.
Now, the thing is, though, if you go back to certain periods of time where you've got like the weighting gets very, very heavy, I'd be curious to see how it goes the next time around, because now those Mag 7 companies are just really highly exposed or highly weighted components of the index. So next time around might be a little different. I don't know.
Yeah, I'm also I read this week BlackRock is introducing a top 20 ETF.
Interesting.
And I just saw this. So iShares has a top T as the ticker. That's the top 20 U.S. stocks. Now, there's obviously no history to this. I feel like this has been relatively new, but I'm curious if this is trying to accomplish, aims to replicate the performance of the top 20 largest U.S. companies by market cap within the S&P 500. Float adjusted weights, implementing caps, 22.5% for single issues. Holdings are adjusted quarterly to align with current market conditions and corporate changes. Investing in these leading companies, top team may also utilize derivatives cash equivalents to maintain alignment with this target index. Okay. I wish there was some history on that just to see it. But stuff like that, I'm pretty interested in moving forward because, we're talking about flight to quality and people are like, well, how do I find quality? This is a pretty good way. If you've got your top 20 or top 50 stocks in the S&P, that's top quality because those will be adjusted. We're getting stocks right now that are getting dumped out of the Dow and put into the Dow. S&P and NASDAQ have had stocks that have been dropped and put back in. So there's all sorts of changes, and these are rebalanced quarterly all the time. So funds like this are pretty interesting. Yeah, I don't know. I think it's something to watch.
I'll leak a little thing here from my own personal kind of strategy going into next year, Chris. Well, let's do something real quick. Chandler, James, if you guys could fish up that link for the webinar event that we've got coming up, that would be awesome if you could drop that for the current chat, if you've got that for us. But Chris and I are putting on a webinar event next week talking about top trade ideas that we will be personally looking at going into next year. It's going to be probably one of the most important webinar events. It is free to attend. We'll have the link here dropped in just a second. I want to ask you guys to register for free if you have not already. There's no paywall, and don't worry. We just want a serious group of people that registers and shows up to the event. If that is you, we'll answer your questions. We'll hang out. It's going to be a great time. But I'll leak one little thing, Chris. Just from a personal strategy standpoint, I think that there's going to be, and I could be right, I could be wrong. Not financial advice ever. I could be wrong, but I think that there's going to be a short-term melt up that persists in the stock market, the crypto market. People may be cheering coming back to the 2020 days, etc. However, if that starts to persist, what I plan to do is slowly start allocating more money into more yielding things, value names over time. So I do think that there's likely a short-term run up in Bitcoin and all that stuff. But I think that I'll take some of those proceeds and start to put them into more secure things, more cash yielding things, continue to do my option selling strategies, dividend stocks, things like that, and slowly start to chip away and put stuff in. If we repeated that process in 2020, 2021, when the market was ripping higher, if you had done that throughout the bull market, then 2022 might not have stung so bad. Does that make sense, Chris? Would you agree,
Absolutely.
disagree? What do you think?
No, I agree. Look, it's really this simple. If you want to take a ton of risk, or I should say, if you're going after a crazy amount of reward, you're taking a ton of risk. I mean, the one thing that's happening right now, since we're going higher and higher and higher, is it is much easier as we get further and further stretched away from these very common dynamic support levels. The further we get away, and that's why I'm saying like this melt up might look great, and this might be just hang on for dear life. But what typically looks inefficient and melty uppy for a sustained period, it usually ends pretty violently.
Right.
And
what
I'm
goes
just
up quickly or down quickly typically has a sharp ultra move to the other way.
Yeah. So if we have a, rocket ship to the upside, then that runs out of gas and that orbit all of a sudden turns and it falls back with gravity. And, we could go up another 5 to 10% on the indexes, but we could fall just as easily that same 5-10%. And of course, if that stokes any fear in the market, that 10% can overshoot. And all of a sudden we've got 12, 15, 20% pullbacks. It just changes very quickly. So I just think for everyone out there that feels like they're throwing money at everything right now, they're just trying to be super aggressive. Like, I get it. It's enticing, but just understand there's probably way more risk to the downside than upside. And if you're looking at asymmetry right now, I think if you go out a year or two, let's be a little bit more like realistic on the horizon, to go out and say like, well, we know what's happening in the next 30 to 60 days. That's impossible. But even over the next year, I don't think the market for 2025 is going to give us another 25 to 30% without having some type of pullback.
Yeah. No, I mean, that's a fair thing to say and fair thing to just remember. And, Chris, unfortunately, everybody in the audience needs to hear this because this is very important. A lot of people who were trading during 2020 are no longer trading anymore. But Chris and I were trading during that time. And I can tell you the feel of a melt up feels so unbearably strong, like that FOMO of like, oh my gosh, I just need to ride this thing. I'm telling you, just be careful, because again, the feeling gets so exciting just before it gets much uglier. And I'm not a bear here. I'm bullish on things. I have long positions everywhere. I'm just telling you that I'm not going to start leveraging my account. I'm not going to start believing that it couldn't possibly go down. And I'm not going to find excuses to buy things when I shouldn't be buying them. Just look at it from a long-term perspective. And even if you didn't trade during those times, go back in your charts and look what happened, right? Things melted up. And then, as Chris is pointing out, what went up very sharply also had very ugly reversals that if you had over leveraged yourselves, you'd be calling trading gambling right now and saying that that doesn't actually work because you were foolish and you did the standard sin of over leveraging and gambling in the markets. Don't let it be you. I'm telling you.
Yes. I know we have. Do you want to bring up your multi chart? We've got some action going on now.
Yeah.
It's FOMC.
Yeah.
I'm just getting my trade alert posted for SkyWest.
Yep, I got it switched over on my screen. We got
Okay,
S&P, NAS here, Dow Jones, guys. 2:00 just hit. Almost certainly Fed cut rates as expected. Bigger question is going to be again coming with the
press conference.
Press conference, yes.
Yep.
So statement, probably. Is there a live stream going on, Chandler James? I'm not sure if we had that primed here for us, but let's see, just in terms of market reaction, you got stock market back and forth here so far. No decisive moves here. Gold, same thing. Let's see. Yep, they cut rates as expected to 4.75%.
Okay,
Keep an
I'm
eye
gonna
on
look at
this.
this statement here. Statement's pretty short and sweet. Recent indicators suggest that economic activity has continued to expand at a solid pace. Since earlier in the year, labor market conditions have generally eased, and the unemployment rate has not moved up but remains low. Inflation has made progress towards the committee's 2% objective but remains somewhat elevated. Committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Committee judges. Sorry if I'm just reading this verbatim, but I'm curious, like going back to last FOMC and the one before that, like, is it just a red line statement? Is it pretty much cut and dry? But I want to see like if they're mentioning anything along the lines of where their target rates are at. So committee judges that the risks to achieving its employment inflation goals are roughly in balance. Economic outlook is uncertain. Committee is attentive to the risk of both sides of the dual mandate. Decided to lower target rate by the 25 basis points. Additional adjustments to the target range will carefully assess incoming data, evolving outlook, and the balance of risks. Reducing its holdings of treasury securities and agency debt, as well as mortgage-backed securities. Strongly committed to supporting maximum employment and returning inflation to its 2% objective. I don't know, man. I think oil is going to be one of the biggest keys to trying to get inflation back down below 2%. I don't see what else. I mean, when you've got CPI, PPI, PCE coming in hotter, I don't know how that changes outside of getting some outlier. Like when energy prices were elevated, so is our inflation. When energy prices, like oil prices, are lower, our inflation was trending lower. So I think if the floor breaks at $65 on oil, we crash to like 50 or 40, 50, 45, $40, like inflation could go way down. Not in a good way, because it's like, well, we got something else breaking in order for inflation to improve.
Yeah, you want the economy to demand oil strong enough to keep the price from falling out below. But oil definitely is a very important one to watch for the inflation story. And there's so many variables here, Chris, because if the whole global conflict situation improves, and for the good of humanity, whether you like Trump or not, let's hope that sort of does play out. Let's hope that there is less violence in the world in the coming years. I hope. I don't know. I just hope. If that happens, oil prices go down, right? Because then there's less demand. There's less concerns about the supply of oil, and that's a potential catalyst for oil prices going lower. But it's also a catalyst if it does not work out to go higher. So these are things that we have to keep an eye on. And as Chris is pointing out, that inflation risk with the oil price, always keep one eye on oil prices. It's really, really important that you do so.
Yeah, and also, I mean, oil is also a pretty good non-correlator to the S&P. So, I mean, there have been times when the S&P is down and oil is actually up. I just think it's been weird to see that we have a completely obvious prolonged conflict in the Middle East, and now tensions have risen so much, yet oil prices haven't done anything to the upside. It really had a short-term squeeze, short-term spike, and that's it. I mean, so I even looked at that strangle today, but I'm like, I just can't justify making $120 to risk $300 and $400. And if something like silly happens, I mean, it's defined risk, but I'm like, it's just a trade. I don't know what's going to happen. I mean, to me, oil, if it was here, Nick, if we're at $80, then sure, way more interested in like the highs and lows because we're right in the middle. But at this point, it's like, okay, so we have a range here and a range here. Are we going to stay that tight within like just a couple of dollars on oil prices? I mean, maybe, but I just think this floor is potentially the breaking point. And if that happens, I don't know. I mean, it'd be nice to go bear put spreads on CL. If we break the floor, go out 30 to 60 days and just do some bear put spreads, make it defined risk. Let me see what that actually charges right now if I do a CL trade. I'm not going to take this trade, but I'm curious. Like, let's go out and say we got a support break on oil. I think we're going lower, and I want to go out maybe 2 weeks. So I go to like a 13 or 15 day CL contract, and I say, okay, I'm going to buy a put at 72, and I'm going to sell one strike lower. I mean, I can risk 120 to make 130. I can do that all day. If I've got a directional play on it, I can do that all day. So that's probably the best way for me to actually trade oil when I feel like I've got some direction that I can play on.
Yep.
So
yep.
anyway,
exactly. So yeah, and that's the thing is when you look at oil prices, I kind of I heard you say it earlier. I kind of feel the same way. Oil prices, generally speaking, in my view, are likely range bound until you get some sort of something big changing, right? If you get, for example, if there is peace in the Middle East, that could actually take out the lows here if it also coincides with like weakening economic data. But I think that, right now, it would take some big change to really get us to make a move outside of this range. I mean, I could see oil prices trending up or trending down, but to get us to break to the upside, we either need geopolitical conflicts escalating, or just a inflation, rise due to just economies going crazy again, right? If you get like a big pickup in economic activity / geopolitical stuff, this could happen. And if you get a big shift to the opposite extreme, geopolitical stuff cooling off, which, again, I mentioned it a second ago, let's hope that is the scenario. Let's hope that in Ukraine and Russia, I saw something on Twitter that Putin put out a statement just saying he's ready to negotiate with Donald Trump. And let's just hope, again, maybe they like each other. Maybe they're best buddies. Who knows? Let's hope that it chills out over there and that, we can get back to doing, more constructive stuff than shooting missiles, right? Let's get past that, I hope. But
I think Melania is the ultimate ambassador. She'll be the mediator.
Yeah. I mean, I'm just saying, like, that is a scenario that, we can only hope that all of those things improve, and that at the same time, something else doesn't fall out of the side in China and Taiwan. Like, there's a lot of things that could happen that you just kind of are hoping, praying, whatever you do, that they don't happen.
Yep. And look here domestically, I mean, same thing. It's like, I think everybody, whether you are Republican or Democrat or you don't give a crap, I think everyone just wants to feel like things are getting better.
Yeah.
It's been a wild, stressful, like,
tough couple of years.
2020 to 2024 was a really tough stretch for a lot of people.
Yeah.
And I'm not going to say that some people didn't benefit from it. Obviously, being an investor, being a trader, there was ridiculous amounts of opportunity from 2020 to now. But even through, 2016 was a difficult time politically because it was some of the most disruptive politics we've ever had in this country. And anyway, point is, it's like, I just think if the consensus is things are getting better, things are feeling better, it's better. Like, that sentiment does go a long ways. And so I know with this new administration, whether it's all Republican, hopefully we're not regressing socially. I mean, that's the one thing I would say I disagree with is, why would we repeal things that are 70 years old? Why would we go back and enforce and litigate things that it's like, that doesn't help anybody. Socially, it doesn't help anybody. Like, economically, look, get government spending under control in some capacity. Stop blowing the debt up by $1 trillion every 30 to 40 days.
Yeah.
And maybe, I mean, I think it's impossible to talk about balancing the budget. I think it's impossible talking about zeroing our debt. But I think it's possible to realize, like, our government doesn't have to spend like it's just without any type of ramifications or any type of consequences. And on top of that, like, we have an economy that feels balanced instead of a K-shaped recovery where those that have do well, those that don't struggle. And there's, you're looking for help and assistance. You don't get it. If we gut healthcare and we gut education and we gut this and we gut this. It's like, okay, I mean, it's like everyone's going to get affected by it some way. So point is, I just think overall consensus, if things feel better and they actually are better, that's good. Like I'll vote for that anytime. I actually had this conversation the other night. It'd be nice, instead of having to vote for a president, what if you just vote on policy?
That would be
Like,
interesting.
give you like the top 25 issues, and then if you check those, it's like what candidate is actually making that their platform, and
Yeah,
that's
and
the
I
party
think that
that you're voting for. I
you'd
think that'd
probably
be a
get
better.
a much larger, sort of agreement group than we currently do. If
Sure.
you could, I kind of, think like most people are like somewhat moderate, and then you just have the extremes that sort of fall the far right, far left. I think a lot of people
Yep.
probably fall in the middle.
Yep.
That being said, from a markets perspective, less regulation, pro-business stuff is probably why the stock market is bumped up here recently. The
Mhm.
question will be, again, the inflation concerns are very valid with the tariff stuff. Economists are not always right. We saw that in 2023, saw it in 2024. In fact, they were dead wrong. But economists are forecasting that the tariff stuff could be inflationary, and that possibly puts a floor on rates and inflation, Chris. I mean, that's something I'm thinking about here is, I don't necessarily see that as a ginormous bear catalyst unless it gets bad, right? If it is a bear catalyst, then it suddenly will be a bear catalyst. Like if inflation not only doesn't it has a floor, but it also starts to really perk up again. Yeah, I mean, you mentioned it earlier, rate hikes. I don't know if we could survive as easily the first time around another round of serious inflation. I think it would be different the second time around, be more painful than it already was. You mentioned it, for the average person, it was really painful. The stock market, many stocks really underperformed. They really had tough times, but the very well-off ones, the big ones, did just okay during even the hardest times of 2022 inflation, right? I mean, that's the question is, I don't know about the second time around. I don't know that the economy has it in it to survive it as easy.
Well, think about how, I mean, I think that 2022, despite the severity and the size of it, like having a 25 to 35% pullback is no joke, but it also came in a very efficient pullback manner. I mean, the VIX only went up to like 35 or 40.
Yeah, kind of a gradual.
We didn't have a vol event. We just had like really steady, consistent sell-offs. I mean, were they big swings? Yeah, they're big swings, but this is a pretty manageable, albeit like not easy to trade because everything was down. There's nowhere to hide. And especially on this stretch here and this stretch here, like everything was red. Bonds are down, equities are down. There's no good place to be. You can't buy anything that's going up. It's just all crap. Anyway, but this was, from a technical side, pretty efficient. Wave, wave, wave. And then once we broke the structure, we haven't looked back since. So you should be looking back on this and being thankful for that's all the bet. That's all the bet. Like,
I mean, look at that compared to 2020, just as an example.
That's my point. And so if we have a 2020 that all of a sudden doesn't V bottom after a month, I mean, think about this. Like, we are so conditioned that like after a pullback, people are like, I'm all in, and it goes down again, or it goes up for a halfway or dead cat bounce and then down again, right? Like a crash that is severe at 10, 15, 20%. So think about this. Let's say we have a 10% crash, Nick, and it pulls back and everyone's like, that's the bottom. And then it goes down another 15 to 20%. That will make everyone feel like absolute trash. And that would be a, 3+% correction, and it happens violently, and there's no good pricing on anything. You're going to have spreads super wide. You have your bid-ask prices all over the place.
Yep.
This will be fine. But I mean, if you want to have cash at the ready, because that's where it gets really, really ugly. And my point to all this is, nobody knows what's happening to the downside. We do know that bear markets tend to be way more aggressive, way faster. And that was a bear market in 2020. Even the correction back in late 2018, when the market dropped 20+%, this is what I'm talking about, dude. This happened over about 2.5 months. From the mid of October to the end of the year, we had 2.5, 3 months of, down about 10%, right? So that was a drop of around 10+%, a dead cat bounce, and then a drop of 16%.
Yep.
So the total pullback was like 20%, but it happened in two giant flushes. And let's say we do that, and then it takes 6 months to a year to actually accumulate a bottom.
The thing is, Chris, like
stuff. That's what's
what's crazy about it is, like, in a weird way, I know that's going to happen again. Everyone in this room should
Sure.
know that that's going
Of
to happen again.
course.
But it feels in this moment, we have to admit, it doesn't feel like it's going to happen. But then it will. Like it will, just doesn't
Yeah.
feel like it. And then it does. That's the way this stuff always plays out, isn't
Do
it?
you want to know what's going to keep this market going up forever? It would be
What's
that
that?
we keep having bear doomsday, everything is making all the headlines, and it just becomes like the easiest contrarian play. Because think about how many people are not participating still because they feel like there's a giant crash and a whole reset around the corner.
Yeah.
That's
Yeah.
part of the reason we haven't had a recession. We haven't had a full-blown recession since 2022. Even though we had a bear market, it wasn't a all-on broad-based bear market. It was waves and waves, and certain sectors felt it. Other sectors were okay, but it was a nasty pullback in the market. But if we have a
Yeah.
2008 all over again, I mean, there's a reason 2008 was so nasty. It was like global financial Armageddon, on the brink of a full-on like financial market collapse.
Yep.
The tools that have been put in place are pretty much put in place to prevent that from ever happening again. So could we have a 2008? Sure, but it'd be a different flavor of it.
Yeah.
I just think that
Some
there's
different
more
variation.
tools to fix it. That's all.
Yeah, exactly. Chris, I'm gonna if you could just take over for just a few minutes, I'm gonna run to the restroom.
Sure.
I'll be right back. And you go over what you want. I'll be listening on my phone.
Okay, sounds good. All right. So I'm just gonna do some spot checks on the 1 minute charts here. I mean, Nick had the chart up. I'm just gonna do a spot check to see where prices are going. It's a lot of noise. I mean, I've got my levels here. We're still trading at 595 on the SPY. If I go to the QQQ, we're still trading slightly up on the day with this melt up. I was looking at the Qs going up to 515. I thought it'd get there by tomorrow. That just kind of lit up all day. So anyway, I mean, it's still been pretty steady. We just kind of paused here. Now, keep in mind, we do have Jerome Powell coming up in 15 minutes for the press conference, which could also be a whole nother chunk to this trade. So we clearly have a lot of noise as the market expected to see a 25 basis points cut. They got the 25 basis points cut, but here we have Powell. Now, is Powell able to drive it higher? Is he able to drive it lower? Is he going to say something the market doesn't want to hear? Is he going to say the same thing that I read earlier verbatim, which is pretty much their statement? I know he's going to have Q&A, but he's probably going to evade like a champ that he is, and he just keeps it like, here's the script, stick to it, don't disrupt the market. And then they want to hope that data gets better. Look, the Fed is watching the data as they should be. The problem is they're probably watching lagging data because stuff that's already happening. I keep going to that trueflation. I'll keep mentioning it because it is a concern that I don't think the Fed is going to be pleased to see. And you can see this on the Edge Finder. Let's go Edge Finder for a second. Let's go to the inflation readings, because here's where I think it looks a little rough. Let's go to inflation data. Let's go year over year CPI. Okay, so this is the trend we've been noticing. So we had 12 months of sideways, and then we finally had 3 to 4 months of good prints. So it's been trending lower. Okay, now as we come into next week, Wednesday, which is the next CPI print, the forecast hasn't been shown yet. But what I'm seeing from the Fed readings, if you go to like the Fed websites and get those Fed reports, I think it was the Atlanta Fed was forecasting a 2.6. Okay, 2.6 is which direction? Okay, this forecast was 2.3, came in 2.4. If they forecast 2.6 and come in 2.6, that all of a sudden turns from this trend to then shifting up. Okay. Now, I know that might not be a big deal, but what happens if we shift up over the next couple of months and we're right back where we started at 3%? And this thing for the last year and a half has made no sustainable progress. And it becomes it's a moot point if the Fed keeps saying 2%, 2%, 2%, when the reality is we're never going to get there. They can say it all they want, but the reality is if they're willing to operate within a 2 to 3% inflation range target, they should just freaking say it. Because saying 2% and watching this trend higher and doing nothing, right? I mean, this is what Frank and Nick were talking about. If we go higher on inflation and the Fed all of a sudden raises rates, they're going to look like idiots, you know? And I know you're giving 12 people a lot of power to be in the Fed, but I don't think the Fed should be raising rates in 2025. If anything, they're trying to get their mileage that they can right now, delivering on what they said, get this melt up to happen, and then in 2025, then all of a sudden we start to see maybe 1 or 2 cuts when appropriate. And when is that? I don't know. I mean, would they cut in March? Maybe. Would they cut in May or June before summer? Maybe. Would they cut late in the year after they let all the economic data come in? Maybe. Right? Because, I mean, think about it. This market has done amazing things with the Fed that gave us all sorts of wait and see, wait and see, wait and see. This market kept moving. At some point, the market stopped caring about the Fed this year, okay? Because things were better, earnings were fine, interest rates weren't going up, but there was forecast and anticipated they're going down. And sure enough, as of September, they did. So there's going to be a couple more cuts. That's looking like the highest probability. 2025 is more of the same. It's wait and see. What's the Fed going to do? The market doesn't care as much, but I promise you the market will care if our inflation goes from 2.4 back up to 3% and the Fed still starts hammering like 2%, 2%. If they keep saying it and it doesn't look like it's realistic, then clearly their target is more of the 2 to 3% inflation range that they will stay and live with, and they'll deal with it. But if 3% is like, well, the Fed's not going to cut rates any further, 3%, like how bad is it getting? What areas of the economy are showing higher inflation? So I mean, it's all going to be wait and see. And what sucks is these are monthly prints. So CPI is next week, and then PPI, I think it's the same week, right? Maybe it's the following week. Let me check the calendar here. But does everybody see what I'm saying? If we look at the Edge Finder, you go to the trend. I mean, if we have we go 1, 2, 3, 4, 5, 6, 7 months trending lower with consistently lower year-over-year prints, and all of a sudden we have a 2 to 3/10% higher. One data point doesn't make a trend, but if you can connect the dots on 2 or 3 of these till the end of the year, and we go from 2.4 lowest CPI to then 2.7, 2.8, or even 3%, that just shows we have gone nowhere since July of 2023. We've made no real improvements outside of a temporary relief. So anyway, how'd you enjoy that bathroom break, Nick? Was that good data for you in the bathroom?
It was great. I enjoyed your breakdown here. Did you like it? We added the red dots here just to see the forecast because we thought that was pretty valuable to have.
Yeah, for sure.
Not just the inflation, but be able to see the forecast as well. I mean, just listening to what you were saying about inflation, where it is, it's like Fed does not want to mess this up from here. They've got most of it behind them, but choosing to cut rates too soon, that would be the worst case scenario, because then if they do go too fast and the economy is just still, if we didn't really truly fix the situation, which is the economy was like kind of having a melt up in 2022, 2021. If we don't fully let that situation cool off and inflation return to a normalcy, these things are very lagging. They're very slow, right? Inflation processes can take some time. And I hear a lot of times people say, well, prices haven't started going down yet. Well, trust me when I say you don't actually want that to happen. If prices
won't go down, they
won't go down. And if they do, it's a disaster because the economy is falling apart.
Yes.
So
prices
you just
won't
want them to go up slower.
Yep. And yeah, and that whole note, it's like for us to say, like, if you take a chart of inflation at 2% a year, it looks like this. Chart of 2% inflation looks like this. Okay, it is a hidden tax that we will pay every year, whether you like it or not. Okay, but the reality is what we saw since 2020 and 2021 is that their real inflation has actually been more like this. And that's where we are. And there's about 11% difference between where we're actually at and the 2% inflation target that the Fed is talking about. So we're nowhere close to what's technically restrictive that would actually help like temper this inflation rip that we've still been seeing and we're still dealing with. And that's why it doesn't feel any better. And so if anyone wants prices to go down, prices will go down here, Nick. House prices will have to come down. Why? Because it's funny money and nobody's house is really worth that much square footage wise. Houses are not worth 100% more than that you bought them for. I'm sorry.
That's the thing. The thing, Chris, is that we all want prices to go down. Who doesn't want a discount? Right. But the difference is, do you want prices to go down if it also means you also have to lose your job, your house prices get slashed, your stock portfolio drops tremendously.
Exactly.
Those are things you can't have one and not the other. That's historically throughout U.S. history. When prices go down, it is usually accompanied with recession, which hurts everyone really bad too. What we really want is what the Fed is trying to do, which is stable price rises at 2% are bearable. Because if people are getting wage increases that are comparable or more, then it's okay, right? Prices going up is going to happen over time. The difference is you don't want prices to go down because then you lose your job, and you don't want them to skyrocket because then your real income gets destroyed.
Yep. Yeah, those are great points. And that's the look, there's always a trade-off here, right? So you might want prices to go down, but it comes with all the consequences that Nick just mentioned.
Yep.
So you have to
Can't
think
have
like
them
there's always going to be a
independently.
trade-off. I mean, the reality is if things are okay, I said this earlier, and this is just straight up from Ray Dalio, save more than you spend. That's going to help a lot of people. It's hard to do. I get it. Life's expensive. Everything's expensive. I hear people that, hey, my housekeeper, my house cleaner, somebody that comes by once a week, they're paying like $1,000 a month for this when it used to be like $100 a month. Something. So it's that. I mean, going to get like ladies getting a haircut, spending $200, $300, $400 for a haircut. It's crazy, dude. I don't cut my own hair, but I will say that I don't spend more than like 30 or 40 bucks to get my haircut.
Well, I no longer get haircuts, Chris. I gave that up because prices went up too much. Now I'm never cutting my hair again.
Well,
So
I mean,
I'm
you've
just gonna
got
grow it
great
out.
genetics then, because it's like perfectly the proper length all the time. So that's pretty impressive.
I think I've just it's a wig actually. That's
right. Yeah.
It's invested in one wig.
One day we'll reveal what Nick's true hair looks like.
Exactly. I'm a redhead. You just didn't know it.
Oh boy. Yeah.
Guys, we got just a few minutes here before Mr. JP takes the stand. And just a reminder, although this week has been riddled with paying close attention to who the president's going to be and what that's going to mean, don't forget who holds the real keys. It is Mr. JP. The Fed and what they choose to do is very, very important to what the market actually sort of does in the coming. At the end of the day, Donald Trump, Kamala Harris, all this excitement, they don't control how these businesses perform. What drastically helps or hurts them, the businesses of America, which are driving the stock market, is the actual level of inflation and employment levels and how much stimulus there is from the Fed or lack thereof. These are the things that, if you inject money into the system, that's going to help it. If you don't, it's going to let it cool off. So we'll see what they have to say.
All I know is on this currency strength chart, I want to get this single person EV. That's what I want to see.
Yeah. You didn't get one yet?
Not yet. I think maybe it's ordered. It's behind the Cybertruck that I've got coming. It's actually coming in the trailer of the Cybertruck that doesn't exist.
Would you buy a Cybertruck, Chris?
No.
You don't like them?
No, I see too many around here, and I've seen too many videos where people literally tear them apart with their bare hands, and I'm like, it's probably not the highest quality vehicle to have. And
wow.
I drove in the Tesla SUVs. And I mean, at this time, it's like they were $65,000, $70,000, which I think for that type of price tag, you got to have like a pretty high quality SUV where it's quiet inside. You don't feel a bump. Everything's pretty silky smooth. Tesla's not that vehicle. So, I mean, look, I like what Tesla has done. I'm bullish on the stock. I think Elon Musk is going to be intentionally making that company probably the most profitable company in the world. So, I mean, we're already sitting, I think it's over $1 trillion market cap right now, I think. But we're sitting at 954 billion. I think that'll be one of the faster rips to $1 trillion. And I wouldn't be surprised if it is a $1.5 to $2 trillion in the next year. Like, I mean, look at just the technicals alone. I know we got Powell coming on in just a few minutes here, but on technicals alone, I have been waiting for this to be a breakout. So although I'm sitting here at these highs and I'm not buying more shares at the highs, what I am doing is ratio spreads, credit spreads, debit spreads, whatever I can get my hands on. I'm trying to position for, I'll take some stabs, some income plays. And if I get the pullbacks and I get some assignments, fine. But look at this chart. I mean, when we had this all-time high, all this was to me was a high, low, lower, high, lower, low. We build this wedge. We accumulate to show who's in control here. And the bulls are in control. And this now to me is open space to then get back to all-time highs. So just like I was long Amazon this year, getting back to all-time highs, breaking all-time highs, Tesla's now that same stock for me where I think there's good upside potential.
I like that.
So anyway, I like Tesla a lot. And to that point, but no, I'm not going to buy a Cybertruck. And no, I'm not going to buy, I mean, I will get a Tesla car if it's like, $35,000, $40,000. It's okay. But cool. I also need to, I mean, dude, I live in the mountains out here. And when winter hits, I know too many people that have Teslas that have like the extended range batteries that's supposed to go like 350 to 400 miles. And it maybe lasts them like 150 miles because of the elevation, because of the time, because of the temperature. It's a third of what you're supposed to get on the mileage. And I'm like, well, I mean, there are some days that I'm driving 60, 70 miles and then it sits all day in a parking lot freezing at winter. It's like we get a foot of snow. It's like, I don't want to be stranded somewhere.
Yeah, exactly.
So
Well,
anyway,
Chris, I got some Tesla plays as well. I've got a covered
Okay.
call on it. I sold puts on Tesla, which those are doing quite well. My shares
Nice.
are doing quite well. Issue is I sold a covered call, it shot up to 290, which is where my covered call is. So that goes out until let's
You
see,
gonna
when
roll
do I
that
got
bad
that
boy,
up to?
dude?
I might November 22nd. I might just let it go. I've got so many risk on positions right now.
Okay.
I may just let it go and look to maybe start the process again, start selling cash secured puts at some point if we get a dip in Tesla. So I don't know.
Yeah.
I like the stock a lot too. I
Yep.
think, especially whether you like the situation with Elon Musk getting all involved with politics or not, I do think that him being buddy with Trump, I'm curious to see what happens there. I don't know if there's some hospitality between the two of them or not, because previously, EVs was not on Trump's positive list, but I don't know. We'll see. I do
Yeah.
also want to mention for everybody who's listening, we're about to watch the event here. He's coming to stand. Just to mention, if you're a regular stream viewer, our Black Friday sales going on. Everything is currently 40% off, including Chris Pulver's trading signals, which are offered inside of our group. You can get 40% off. Link is in the description down below. We do have the stream ready in just a second. He's coming on, so don't miss the 40% off sale. Link is in the chat right now if you want that 40% off offer.
All right, JP, let's see it.
Mm-hmm.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 0.25 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timrose from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long run rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
It's you get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall, feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
I can't. We don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? That we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September. And in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way. We're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. We're just going to have to see where the data lead us. We have, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but I would say, I would say that, again, we didn't update the SEP, so I'm not going to characterize, where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation in the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in what I've said. The path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates? And are rising deficits a concern to you?
So we don't comment on fiscal policy. And again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outline. So we'd start to model it. And then we'd wait. And then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that. And then the law actually passes. And you'd start to put it. You'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So we have a very large economy. Many things are affecting it at any given time, and a law change of some kind would go in there, but it would go in. But it would it's a process that takes some time. Clearly, the legislative process takes a lot of time, and of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect, and the overall effect on the economy at any given time? So I think that's a process that takes a lot of time, and that we go through all the time with every administration, constantly. And this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against, in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is, how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find 3 weeks later the 10-year was 50 basis points lower. So it's material changes in financial conditions that last, that are persistent, that really matter, and we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Chris.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But, of course, our mandate is maximum employment and price stability. And we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate. And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral, or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset purchase, with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is, I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation?
Chris, I feel like we got the gist of it here. If anything drastic happens in the charts, then certainly we can turn it back on. We'll keep it on the sidelines, but not a very eventful thing. Did you catch anything that really stood out to you, Chris? I mean, this seemed pretty standard.
Don't rock the boat. That's all it
Yeah.
was. It was
Yeah.
already anticipated with the rate cut. Don't make it seem like you made the wrong decision. Everything stays the same script. And I mean, I thought some of those questions were great because they're like trying to get something out of December and something about pausing. And what about 2025? I mean, that's why I mentioned to you. I'm like, did he just say we don't comment on fiscal policy? Like,
Right.
that's the Fed, dude. Like, you are fiscal, like your monetary policy. But I mean, clearly it's going on where you had to balance the stuff out. He's mentioned fiscal policy many times with what's happening to the economy.
He basically said that, they asked him the question that I think a lot of us were wondering about, which was with the change in administration, if some of these things look like they're going to get passed into law, are you guys going to be anticipatory at all? And then he said, no, we're not going to anticipate anything, but then finished shortly after by saying, if it looks like they're going to get passed into law, we'll start mapping out what that could mean for us. And I was like, but you just said you're not going to anticipate. So
It's classic, right? I mean, that's what I mean. And honestly, I was starting to trade when Bernanke was the guy. It was like Greenspan, Bernanke, and the Fed was never as, to me, like as a trader, it never meant as much as it has the last 8+ years, 10+ years, when it was like Yellen to now Powell. I mean, they're very crafty at what they say. There's clearly a lot of power that 12 people have, and one in particular with being the chairman. I mean, I think the Fed they're backed into a corner because they have to be transparent. They're trying to do everything to say all the right things, do all the right things to make sure that everybody is happy in the market. And their real job is employment, price stability, and making sure nothing breaks. But the problem is that things break and they get reactive. And that's what they're known for. That's what's been happening for the last 2 decades. And I just think that right now they've been pretty lucky that nothing's really broken too badly. And eventually, like you and I talked about earlier, something will break, and the Fed will be there to create something, do something, backstop it somehow. And you just got to wonder like how the market takes that. And I mean, nobody knows when and how, but everything Powell said could have been taken one way or the other. Like, they cut rates today. Is that good or bad? Price suggests it's absolutely meaningless. It's like it's already been priced in,
Yeah. And I think that, I said this to Frank recently as well. I don't think that whether they will say it or not, that they really can completely ignore what's happening on the, administration side. If they all think that tariffs cause inflation, then they're going to factor that into their voting, et cetera. But we'll have to see. I do think that the responsible thing is to do what he mentioned, which is basically, let's wait and see. Let's actually start to map it out when we have more information, all that sort of thing. So, we'll have to see. But it seemed kind of just like a nothing burger, to be honest. It was mostly at least for now. We could see in an hour there was something that we missed, but markets are mostly unchanged to where they were before the meeting, slightly higher for the stock market, perhaps just a tiny bit of risk coming out of the market, since people never know what he's going to say. But it didn't seem like he said anything of super high interest to the markets. Chris, I'm gonna hop off pretty soon here. I imagine you may be done too. We've been streaming pretty much all day, but if you're not, you're welcome to keep going.
I actually have another session that I usually run at 3 p.m.
Okay, so
I'm
you gotta
happy
run
just to
too.
keep this session running, or I can like close out and I'll get right back on my YouTube channel. So it's up to you guys if you want to end the stream and wrap it up, so nobody has to stick around and just watch my session. But
No, you
I've got another
guys,
session to run.
You go ahead and run, do your thing. You got your closing session. By the way, if anybody would like to join Chris on that, we'll drop the link to his YouTube channel, Chris Pulver on YouTube. Search him up. You can find him there. We're live all the time, both on this channel and his. Chris, thank you for coming on, man. I appreciate your commentary today.
Of course, man. We'll see you tomorrow.
All right. See ya.
Thanks, Nick.
Yeah, guys, we're gonna close out here. I do want to just do quick plug to final thoughts. We've been streaming all day long. If you enjoyed the show today, we've been streaming for, at this point, 6 hours 45 minutes, which is insane. We've had guests from all over the world taking over and sharing the stream here, so it's been awesome. If you guys enjoyed the show, hit the thumbs up button, and also remember, if you want access to the Edge Finder or to our VIP signals room, you can get access to Chris Pulver's trade alerts. They are now available, and everything is 40% off. So if you have any questions, you can speak directly with a member of our support team using the link being dropped here. Don't miss it. It's our biggest sale of the entire year. We've got just activity going crazy here recently. We've been trading this whole week. It's been a really crazy week, and we've been pretty risk on in our sentiment. This week has been incredibly good for my own trading. I wish it was always this good. Let's just say that, but it's been really good this week. So anyways, don't miss the sale. Everything 40% off. Biggest sale of the year. Send us a direct message if you have any questions or you need help. And appreciate you guys for watching. Thank you guys. Have a great rest of your day, wherever you are tuning in from. And we will see you back on the next one. Cheers.